a structure or management accounting paper. Okay, as we all know, the question or the exam is going to be in 5 questions. Okay, so you are going to be answering 5 questions, 5 solid questions in 3 hours. Okay, they will give you 15 minutes reading time. That 15 minutes, you can take the 15 minutes to read through the questions and know where you are going to be starting from. So the 15 minutes, don't go and be using your 15 minutes to write anything now. Just scan through the questions and know where you are going to be starting from and have some idea about how to start the questions and those things. Okay, don't take your 15 minutes to focus on one question. No, scan through the questions, develop a plan before the 15 minutes will elapse. So look at it. Okay, which question am I going to be starting from? How do I go about it? Then you can use the 15 minutes for that. After the 15 minutes, they will ask you to start the questions, and you are going to be using at least 30 minutes for each question. You are going to be answering 5 questions. So you'll be looking at the question one. Okay, the question one is about performance evaluation. Okay, resources are going to be entrusted under the care of what? Others. The owners are going to be leaving their resources under the care of what? Of managers or directors. So at the end of the day, they have to be held responsible for the resources that they have been what? They have been managing, or the resources that have been left under their control. So we have to measure their performance. We have to look at whether they are doing well or they are not doing well. So we use certain tools to do that. So the first one is we will be looking at the normal ratio analysis that we know. So we'll be looking at the ratio analysis. So you can use a ratio analysis where they can give you a financial statement and ask you to calculate certain ratios. And you have to also use the ratios to measure the performance of that particular division or entity. We also look at what we call measuring divisional performance. So we can go to divisional performance. Under the divisional performance, what do we use? Okay, so under divisional performance, what do we use? We use what we call the return on investment, which is basically the same as what? The ROSI. But for the return on investment, we use profit after depreciation. Profit after depreciation, but before tax. So profit after depreciation, that's what we use over here. But it's basically like what? The return on capital employed. We also use what we call the residual income. Residual income. The residual income is we look at the narrative as, okay, assuming we are paying for the capital that we are using to generate that particular income, what should have been the residual income after paying for that particular profit or after paying for that particular capital? You are taking the money of 20,000 from your brother, and your brother, if your brother should go and invest this particular amount of money in the bank, he will be taking 10% every year. Okay, so the return that you are making from using this particular 20,000 is 5,000. The question is, assuming you want to pay your brother for the capital that you are taking from him, you are going to be paying 10% on this, and that will give you 2,000. You are going to pay the 2,000 out of the profit that you have made or out of the money that you have made. So if you, assuming you have to pay your brother the 2,000, how much will be left for you? The amount that will be left for you will be 3,000. That's what we call the residual income. So we factor in what we call notional interest. Assuming we have to pay the what? The capital investors for their capital. After paying them, what will be the profit that will be left? That's what we call the residual income. We can also use what we call the EVA, which is likely to appear in your exam. They can still, although last sitting was return on capital employed, return on investment, and the residual income, but they can still examine that particular one. So we try to pick questions on all of them. Okay, but the EVA was examined only once. Okay, so it is likely to be your exam, or the ratio analysis can also be your this. Any of them can come, so you don't have to gamble with yourself. Okay, just try to get maybe 80% of the understanding on all of them. We use the economic value added. Okay, for the EVA, we try to factor in the cost of the capital, which is the interest that we're supposed to pay. But this particular one, what we use over here is we use profits. Profit is including both cash and non-cash items. So if you're using profit. Profit will not reflect the actual return that you are giving to your shareholders in terms of cash. They are giving you cash. So the return should also be in a form of cash. Okay, so let's now adjust our profit to represent what we call cash profits. So it's just like the EVA, just like the return, the residual income, but just that we use cash profit instead of accounting profit. So let's look at the actual value that has been added in terms of cash. These people, they are giving you money. So they are expecting cash in return. You can't be saying that profit is not cash. So what is the actual value that has been added in terms of what? Economic value, which is the cash profit. So we try to adjust our accounting profit with the non-cash items, try to add and subtract certain items. So we look at how do we adjust that particular profit. So depreciation, some non-cash items will be there. We add it back to our profits. Interest is already captured. We are using capital employed. So the capital employed is the shareholders fund plus the long-term debt. So the interest component has already been captured in the cost of capital. So we have to add the interest also, but we look at how we actually adjust the profit and also the capital employed and how we calculate it. So after that one, we look at inter-trading. Okay, trading within the group. So we have a company that we have so many branches. One of them will be producing, one of them will be selling. So we have to, there should be a trading between them. The one that is producing will be selling to the one that is selling. And this is going to be what? In internal sales. So we look at what we call transfer pricing. Okay, if there should be trading within the group, at what price should that particular transaction be at? That's what we are looking at as transfer pricing. So we'll be looking at transfer pricing, how we go about it. So these are the things that we'll be looking at this evening. Ratio analysis, divisional performance, looking at the return on investment, residual income, EVA, transfer pricing, and that is it. So we try, within the 4 hours, we try to solve questions on these ones. Okay, so that is going to be very simple. We are going to be starting with, let me see how the question has been arranged. So we start based on the question. So we'll be looking at the, okay, we'll be looking at the EVA first. Okay. We'll be looking at the EVA first, which is economic value added. So let's look at the economic value added. Okay, the economic value added is just like, what is the what? What is the return in terms of cash? You have taken someone's money to transact business. So at the end of the day, what is the cash return that you have gotten from that particular amount of money? So if you should pay the return, if you should pay interest or return on the capital that you are taking, what would be the what? The remaining value. That's what we call the economic value added. So this is calculated as, okay, so we have what we call the no parts. Okay, that is operating profits. After net operating profits after tax minus what we call the notional interest, or someone can call it imputed cost. Okay, or the notional cost. Okay, how do we calculate the imputed cost? It is calculated as, okay, so you look at your capital employed multiplied by the WACC of the organization. So WACC, how do we calculate WACC? We look at that. So multiply by the capital employed. And the capital employed should always be the opening balance, because it is the opening capital that we are going to be using for the year. The closing capital, we just add the profit to it and have the closing capital. So what is the capital at the beginning? That is the capital that we are going to be using for the business. So it should always be the capital at the beginning. How do we calculate WACC? WACC is the same as how we calculate WACC in financial management. So the WACC will be, the question will always give you a clue on the WACC. So value of equity, which will be the market value, mostly it will be given to you in percentages. Okay, so we have the value of equity divided by value of debt multiplied by the cost of equity, which will be given to you. This is not financial management, so they will not be expecting you to do more of this. Okay, plus then you have your value of debt divided by value of equity plus debt multiplied by cost of debt into bracket 1 minus 2. Mostly we use the after-tax cost of debt. After-tax cost of debt. So this is how you are going to be calculating it. Those who have done the financial management with me, we know how we normally get this one. Okay, we are not here to do how this particular formula has been arrived at. Okay, so this is how we do. How do we calculate our no part? That is the problem now. Okay, the no part that will be given to you will always be accounting profits. Okay, so the question will give you accounting profits. So accounting profit is including both cash and non-cash items, but we are looking for economic profits, which is going to be cash profits. So you take your no part or you take your accounting profit. Let's say you take your accounting profit. Okay, you take your accounting profit. Okay, let's say you are being, the question will give you the accounting profits. So let me just take this one. So let's say the no part is economic profits here. Okay, so you have the economic profits, then the accounting profits. Let's see, let's just assume some figures. So we have the accounting profits. Okay. Okay. So we have the accounting profit. This is including both cash and non-cash items. So the first thing that you have to adjust against this one is that accounting depreciation. The question might be giving you economic depreciation. Economic depreciation is the cash consumption on the item. So in terms of cash, what is the cash value that has been used for the year? That's what we call the economic depreciation. Accounting depreciation is based on estimates. So we can be using 20%. What's the actual value of the equipment? The value that we have used is what? Is 20,000, or how the equipment is going to be generating revenue to us. So we try to find the economic, what is the cash portion of the asset that has been consumed during the year. Mostly the question will be telling you that the accounting profit is the same as the economic what? The accounting depreciation is the same as the economic depreciation. So if you add and subtract, it is going to be having no zero effect. So if they are different, then you add your accounting depreciation back. Okay, so you add your accounting depreciation back because depreciation is a non-cash item. Then you subtract what we call economic depreciation. Economic depreciation is the actual cash portion of the asset that has been consumed. So you subtract that. Okay, the next one is you are going to be given non-cash items. Non-cash items will be provision for doubtful debts, loss on disposal. They will just put it together and give it to you as what? Non-cash items. That will be including provision for doubtful debts. That can be an impairment of assets, and all those non-cash items. They have been adjusted against our profits. They have been added or they have been subtracted. So it is reducing our cash position. So we come and add the non-cash items back. So you add non-cash expenses here. So they can, non-cash expenses, they have been taken away from our profit. So you add. So non-cash expenses will be added. So you can be asked to adjust that, or you can be, they can give it to you as a figure. Okay, the non-cash items, deferred tax will be part of it. Because deferred tax is not cash that we are paying. It's not part of the tax that we are paying. We are just estimating the tax consequences of a particular event that will happen in the future. So they can give you a deferred tax. Deferred tax is not cash that you are paying. So you have to adjust the deferred tax against your profit also, because it has been taken away from the profit. So you go and adjust it. So you have your this thing over here. Okay, let's look at the important items. You also have interest. Okay, you also have the interest. The interest will always be after tax interest. Okay, we are not charging the interest to profit or loss. Interest is tax deductible. What do we mean by interest is tax deductible? The tax authority will allow you to what? To subtract your interest from the profit before they will charge tax on the remaining figure. But since you are not subtracting the interest now, it means that you are going to be paying tax on the portion that is the interest. So we always bring after tax interest over here. So the question will give you the interest expense. Just look for your tax rate. If it is 30%, find 70% of that. That is after tax interest. You come and add over here. Okay. What again will you be having over here? You can also have intangible assets. Like there can be a development expenditure. Development expenditure that is going to be for maybe the development expenditure will be for 3 years or 5 years. But you are writing off all the debenture, all the development expenditure against the profit. You have to go and now add it back and amortize the development expenditure over each useful life. So mostly you might not be getting that. The amortization, you can incur development expenditure of 2,000, which is going to last for 5 years. The question will tell you that the company has written off all the development expenditure against the profit. So you go and add the 2,000 back and only charge an amortization of a year, which will be 2,000 divided by 5 against your profit. That is also going to be fine. All right. So these are the basic adjustments that you'll be doing to this one. There are lots, but these are the basic ones that you'll be seeing. So this will be on no part. How do we calculate our capital employed? So how do we calculate our capital employed? Okay, the capital employed, it will always be the opening balance. It is the opening balance that we'll be using for the year. So you get your opening balance. Okay, there will be certain issues for the year. Okay, we have something that we call non-capitalized leases, which is operating leases. Okay, non-capitalized leases, which will be operating leases, non-capitalized operating leases. Okay, if you are leasing an asset, you are going to be using the asset to generate revenue. So the asset will be seen as a form of capital that you have employed. You are going to be using the asset to generate revenue. So the lease is seen as a form of capital that you are employing to generate revenue. So the lease, capital lease, or the no capitalized operating leases will be added as part of what? Of the investment. You are doing an investment in asset during the year, which has also contributed to the profit that we are going to be using. So we add that one also. Okay. You also have the intangible assets. Okay. I've spoken about the intangible assets. So assuming you incur research and development cost of 2,000, you have charged all of this one to your profit or loss, but the actual year is 5 years. So what you do is that you charge only 1 year and bring the remaining 4 years over here. So that is also a development that is going to be adding to your capital. It's something that is going to be generating a return for you for the year. So you add that one also. You can also have an advertising expense that they will give you that this will last for 5 years. So you also amortize it over the 5 years. So maybe you incur advertising costs, you have charged it to profit or loss, but you only amortize a portion that has been used. The remaining one will be added to the capital employed. Okay. You can also have non-cash items. Non-cash items, this is how we do it. For the non-cash items, okay, example, provision for doubtful debts. Okay, provision for example, provision for doubtful debts. Okay, so if you have provision for doubtful debts, okay, this provision for doubtful debt for this year will have no effect on the capital employed. It will not have any effect on the capital employed because it will be reflected in the closing capital employed. Okay, but this particular provision for doubtful debts, which is this year, okay, which will be 200, this will be subtracted from what? Our receivables. So this will be reflected in the capital employed at the end of the year. So it means that next year, the capital employed will be affected by the 200 because this 200 has been subtracted from the closing capital employed over here. So this is going to be affecting our next year capital employed at the beginning. So the provision or the non-cash items will always have effect in the following year capital employed because we are using opening balance. It will not be subtracted, but it will be subtracted to get our capital employed at the end of the year, which will become opening balance in the following year. So the non-cash item has effect on that particular one. So if it is provision for doubtful debt, you have to adjust it against the following year what capital employed. So this will be having effect in the following year, not the current year, because this has no effect on our opening capital employed. It has no effect on the capitalized operating expenses. We are just using their actual values, but this will be having effect on the current year debtors. So it means that the debtors figure for the next year, which will be the opening balance, will be reduced by this amount. Go and add it because it's a non-cash item. Add it to your capital employed, then you move on. So opening balances, capital employed, intangible assets, and I'm sure these are the so with the non-cash items sometimes also have effect on that. Okay, this is how we go about it. It's no any big deal. Your ability to adjust your net operating profit after tax and your work is the only thing. It's not a big deal. Okay, so let's pick a question on that. Let's pick the question one.
Hello, sir.
Yes, yeah.
Sorry, can you please just go over the provision for doubtful debts for me? I couldn't get that portion.
No, there's a portion over here. So maybe if I solve it, you'll be okay.
All right.
Oh. Okay, someone should read the question for us.
Dela Power Ghana Limited is a power utility company providing power distribution services to the public and businesses of southern Ghana. The company was formed when the government-owned Power Holding Company of Ghana was broken up into regional utility companies, one of which was DPG, and sold into private ownership over 4 years ago. As a vital utility for the economy of Ghana, power services are a government-regulated industry. The regulator is principally concerned that DPG does not abuse its monopoly position in the regional market to unjustifiably increase prices. The majority of services, 80%, are controlled by the regulator, who sets an acceptable return on capital employed into bracket ROCE level and ensures that the pricing of DPG within these areas does not breach. Please. Okay. So the majority of services, 80%, are controlled by the regulator, who sets an acceptable return on capital employed level and ensures that the pricing of DPG within these areas does not breach this level. The remaining services, such as provision of meters and contract repair service, are unregulated, and DPG can charge a market rate for these. The regulator calculates its ROCE figure based on its own valuation of the capital assets being used in regulated services and the operating profit from those regulated services. The target pre-tax ROCE set by the regulator is 6%. If DPG were to breach this figure, then the regulator could fine the company. In past, other such companies have paid fines amounting to millions of naira.
It will be Ghana cedis, millions of cedis.
Amounting to millions of cedis.
Okay.
The board of DPG is trying to drive the performance for the benefit of the shareholders. This is a new experience for many at DPG who left the public sector 4 years ago. In order to try to better communicate the objective of maximizing shareholders' wealth, the board has decided to introduce economic value added (EVA) as the key performance indicator. The finance director has provided the following financial information for the year ending 30th September 2018. The lab power services. So we have regulated and non-regulated, and then the total. We have revenue, operating costs, operating profits, finance charges, profit before tax, tax at 25%, profit after tax. Then capital employed, measured from published accounts, and then measured by regulator for regulated services only. Please, I'm done.
Oh, you have that down.
Kindly scroll up for me. I can't.
Can you see now?
What I see here is capital employed,
Oh, really?
measured.
Who can see something different?
Can see notes. Total operating cost.
Yeah, notes.
Yeah, so the person who is seeing the note should read for us.
The ladies will read. Why I'm in the class and I'm making notes.
Okay, please, can I read?
Yes, please. Yes, please.
Okay, notes. So we have total operating costs included 2018, 2017. We have depreciation, provision for doubtful debts, research and development, other non-cash items. And then we have 2. Economic depreciation is assessed to be 41.5 billion Ghana cedis in 2018. Economic depreciation includes any appropriate amortization adjustments. In previous years, it can be assumed that economic and accounting depreciation were the same. 3. Tax is the cash paid in the current year. That is 4.5 billion Ghana cedis and an adjustment of 0.25 billion Ghana cedi for deferred tax provisions. There was no deferred tax balance prior to 2018. The provision for doubtful debt was 2.25 billion Ghana cedi on the 2018 statement of financial position. 5. Research and development is not capitalized in the accounts. It relates to a new project that will be developed over 5 years and is expected to be of long-term benefit to the company. 2018 is the first year of this project. 6. Cost of capital of DPG. So we have equity, 16%, and then debt, that is pre-tax, 5%. 7. Capital structure of DPG. We have equity to be 40% and debt to be 60%. Required. Evaluate the performance of DPG using EVA. B. Assess whether DPG meets its regulatory rules, targets, and comment on the impact of such a constraint on performance management at DPG. B. To measure the performance of a division manager in responsibility accounting, it is suggested that performance of each division manager must be assessed using controllable profits, not traceable profits. Required. A. Explain the term responsibility accounting. B. Differentiate between controllable profits and traceable profits.
Okay, thank you very much. So they are asking us to find what? The EVA, isn't it? Okay.
Yes, please.
There are lots in this particular question. Okay. There are lots in this particular question. So what we do is you start with your profit after tax. Okay, let's just start with our profit after tax. Okay, we are doing it for the two or for the entity as a whole. So the regulated and non-regulated, they are all going to be one. Okay, so let's just start with the profit after tax. Okay, then we now adjust the non-cash items against it. So start with the profit after tax because some of them should be deducted from the profit. Some of them should not be deducted. Those that are supposed not to be deducted, we add it back. Those supposed to be deducted, they have already been deducted already. So let's start with our north part. So what we do is we are going to be looking at question 1 there. So let's calculate our, it's a very interesting question. So question 1, we have the DPG, which is going to be, so we have the EVE to be equal to the no part, the WACC multiplied by the capital employed. Okay, so let's now look for the adjustment for the no part. Let's start with the no part. Very interesting. So let's start with our accounting profit. So let me just write profit after tax. Okay.
Who has been raising your shorts for you? Who has been doing it for him? No, she has been doing it herself. Eh?
So let's start with the profit after tax. So profit after tax, that will be, so these figures are in billion. Okay, so let's pick the profit after tax, which will be the total. What is the total profit after tax 2018?
It's a loss of
17.75.
17.75.
75.
Okay, so we have 17.75. Let's now come and adjust the items now. Okay, look at this place. They have given you certain items here. Okay, they have given you the total operating costs include, so come here. These are the total operating costs that they are talking about for you. Okay, so the total operating cost over here, which is 34 over here, includes the following figure that they are giving to us over here. Okay, so the depreciation over here, the depreciation is 28.5. Okay, so what are they saying? They say economic depreciation is assessed to be 41 billion in 2018. Economic depreciation includes any appropriate amortization. In previous years, it can be assumed that the economic and accounting depreciation were the same. So it means that this year we have subtracted, 2017, we have subtracted this one from our value of the asset. And they say it's the same as the economic depreciation. How do we show the asset? Carrying value minus the accumulated depreciation. So that is okay. But let's come to this year. What is the depreciation for this year, 2018? Is how much?
29.5. 29.5.
Okay. So that particular amount has been taken from the profit before you get a profit after tax. So go and add this particular profit, this particular depreciation back. So we add the accounting depreciation. We add accounting depreciation of 29.75. Is that correct? Okay. Then you bring what we call economic depreciation. Economic depreciation is the cash portion of the asset that has been consumed.
It's 29.5, but not 75.
Okay. Okay. So we have 29.5. So what is the economic depreciation there?
41.5.
Okay. 41.5. So that is the depreciation that we're supposed to charge. That is the cash consumption of the asset. So we have 41.5. Okay. The next one is what we call, let's bring the interest. Okay, let's bring the finance charge, which will be the interest. So the interest, you bring only the tax what? The after tax interest. Okay. So the question has given us the finance charge over there already. So what is the finance charge? How much is the finance charge? The finance charge is what?
11.5.
11.5.
Okay. So what is our tax rate? What is our tax rate?
25%.
25%.
Okay. So what will be the after tax rate?
75.
75.
75%.
So you find 75% of 11.5. Is that it?
Yeah.
Okay.
It is
How much are you getting?
8.63.
Okay, so you write your 8.63 as the interest. The interest has been subtracted from the profit before we get a profit after tax. So you add your 8.63. Okay. Let's continue with the adjustments. There are certain items that we have to adjust again. Okay. Please, if you're not talking, kindly put your mic off. Okay, so let's come to, we have, yeah, I saw someone's up.
How did you get the
Is that? No, the tax rate is 25%. We are paying a tax of 25%. So the portion that we are not paying the tax for is 75%. So 100% is the figure. You are giving 25% to the tax authority. It means that you are retaining 75%. That is the 75% as a decimal is 0.75. Are you okay? All right. So we have adjusted the depreciation and those ones now. Let's come to other items. Provision for doubtful debts. Provision for doubtful debts. Provision for doubtful debts. Okay. Do we supposed to subtract it?
You add it back.
Okay. But the question now is, okay, so the total operating costs include provision for doubtful debts. Okay, this is not what? This is not total provision given to you. It is a provision for each year because total operating costs include provision for doubtful debt of 1.0. So it means that is the increase in the provision. The 1.0 is the increase in the provision. So that is why they are charging provision for doubtful debt. We charge the increase to the statement of profit or loss. How much has the provision increased by? We charge that one. So since they are giving you a total operating cost include these figures, it means that the 1.0 has been what? Taken away from that. Go and add the provision for doubtful debt. It's not an increase. Don't subtract the 0.25 from the one before you charge. No. They say included in the operating expenses are the following: provision for doubtful debt. They are giving you 1 million. It means that 1 million is the figure included in the provision for doubtful debts. Okay, so let's come to this place. We have the provision for doubtful debt that has been subtracted, but it's a non-cash items. So provision for doubtful debts. Yes, now Benjamin, your hand is up.
Milano,
Yes,
and if you read the note four,
yes, please.
they said the provision for doubtful debt was 2.25 on the 2018 financial statement.
That means they have total it and we are getting 2.25 on that is the total figure. But these are the figures charged on the profit or loss. Provision
So
for
the
that
2.25
is the figure shown on the statement of financial position. Provision for doubtful debt. What do we do? At the end of the day, we look for the increase in the provision. We charge only the increase, but we take the amount, the new provision out to doubtful debt. So this is the provision itself for the 2018. That is the total provision. But the portion that has been charged to 2018 is 1 million.
Okay.
Okay. So it means that the first provision was just 1.25. It was 1.25 for 2017. 1.25, we have added a 1 to it. Now we are having if you add a 1, that is why we have the 2.25. So that is the total provision on the statement of financial position. But the one charged to profit or loss is the 1 million for the year. Okay. So let's have that as the 1 million. So that will be added back. Okay. Let's really pay attention to the adjustment. Okay. We have done the economic depreciation already. We have done, so other non-cash items. Okay. So other non-cash items. How much is for the current year?
3.5.
Okay, so that has also been subtracted. So we add back. Okay, let's come to So research and development, we have taken all the 6 million out, isn't it? The research and development, we have taken all the 6 million out, isn't it?
Yes.
Okay. But we're supposed not to take all the 6 million out. We need to what? Amortize it. So we go and add the 6 million back. How many times? Okay, so we add a 6 million back. Then now let's pay attention to the provision. Let's pay attention to the provision. Okay, let's pay attention to the research and development now. Let's come here. Research and development is not capitalized in the account. It's related to a new project that will be developed over 5 years and is expected to be of a long-term benefit to the company. 2018 is the first year of this project. So from the beginning of 2018 to the end, we have used only 1 year, isn't it?
Yes, sir.
Okay.
Yes, sir.
Yeah.
So we have used 1 year. You only charge the amortization of 1 year. You come to your amortization. You charge your amortization of 1 year. So that will be 6 divided by 5. How much are we having?
1.2.
Okay. So that 1.2 supposed to be the figure that was supposed to be taken away from our profit, not all the 6 million. We need to charge only amortization of 1.2. So the remaining 4 years will be added to our capital employed. You have to be okay with that because this is an investment done during a year, which is going to be giving a long-term benefit to the entity. So that will increase our capital employed. The research and development has also given us what a portion of the profit that we are receiving. So that is going to be increasing. That is also generating or contributing to the cash that we are having or the cash profit that we are having for the year. Let's talk about issues of the.
Yes, please. What you use the is it 5 years or what? 6 over.
Yeah, 6 over 5.
Is it a 5 year?
The research cost is 6 million.
I'm confused with the 5.
The 5 is over. Research and development is not capitalized. Research and development is not capitalized in the account. It's related to the new project that will be developed over 5 years.
Okay.
Okay. So that's what we are getting.
Okay, sir.
All right. All right. Okay. So let's come to the tax issue, the 3. Okay. Tax is the cash paid in the current year. What is the tax paid? 4.5, isn't it? All right. An adjustment of 0.25 million for deferred tax provision. There was no deferred tax balance prior to 2018. Let's come here. Let's come to the tax that we are getting over here. What is the tax paid? What is the tax that has been taken away from our profits?
4.75.
Okay.
4.7.
But what is the cash paid for the tax?
4.5.
Okay, so the 0.25, it has been taken away from the profit, which is not relating to cash. It's deferred tax. Deferred tax is a non-cash item. So what we do is that we have taken 4.75 from the profit. We should have taken 4.5, not 4.75. So we go and add the deferred tax back to our. So we come and add the deferred tax back to us because this is not a cash item. So we add 0.25 as a cash back to our profits after tax. So we have done with the economic depreciation. We are done with the cash. They said there was no prior deferred tax balance prior to 2018. So this is relating to 2018. The provision for doubtful debt was 2.5. That's one they are giving it for us to adjust the capital employed. I'll do that, you see. Then we have the research and development expenditure is not capitalized. We have the cost of capital and pre-tax cost of capital. We have the debt capital structure. Let's now have our profits. So I'm sure we have adjusted everything. Provision for doubtful debts has been adjusted. Let's now get our NOPAT. let's get the no parts now. So what will be the total figure that we'll be having? $17.75 plus 29.5 minus 41.5 minus 8.63. Plus 1 plus 3.5 plus 6 plus 0.25 minus 1.2. I'm getting 23.93.
Yes, sir. 23.93.
Okay, 23.93. So let's now find our
Yes, sir.
capital employed now. Okay, let's find our capital employed. Capital employed should always be the opening balance. Okay, so we have the opening balance. That would be the 2017 figure. Okay, so we have 2017. Let's go there and look for the capital employed. Okay, what is the capital employed? Capital employed at the beginning of the year will be what? For the total entity, not the regulated service. We are doing this for the total entity. So what will be the capital, opening capital employed? Please, the figures given to you are
318.5.
the figures given to you are closing balances. So the 2017 balance will be the capital employed for this year. Okay. Okay. So that will be the capital employed. Okay. What do we do? Depreciation is subtracted to get a closing balance, isn't it? Depreciation is subtracted to get a closing balance. So depreciation for the changes in the depreciation over here will affect next year's 2019's what? Capital employed. Because we are using 318.5, which is before depreciation for this year will be charged. But they say that last year the depreciation are the same. So if the depreciation should not be the same, then we look at the what? The changes that the depreciation will be having. If you look at this, so let me demonstrate that. I should not just talk about it. Let's look at over here. You can see that the depreciation over here is 29.5, isn't it? But the economic depreciation is 41.5. Okay. Assuming these are for 2017, this will be the impact on the figure. Okay. So it means that the 318 over here, 0.5. The figure that we subtracted to get this figure was 29.5, which the figure that we're supposed to subtract should be 41.5. So it means that we have overstated our capital employed. We should subtract 41.5, not 29.5. So we find the difference and go and subtract it from that. If this should be for 2017, it means that the opening balance over here, the depreciation has made that particular figure to be overstated. So we have to adjust the depreciation for the previous year against the current year. It is going to be having an effect on that. But the depreciation for this year is the one that is different. Last year is the same as what? The economic depreciation. So they are all the same. 28.5 was subtracted. Economic depreciation is also 28.5. That was also subtracted. That is going to be having a zero effect. Okay, let's come to the impact of some of the items on that. Okay, we have the research and development expenditure is very important. So research and development is very important on that. So that will be, I'm sure that will be 1.2 multiplied by 4. Do we agree?
Yes, sir.
Yes.
So we add,
6 minus 1.2.
okay, so we add that one. Okay. Please, other non-cash items, unless they have defined that for you. If it is being defined for you, then you can adjust it. But if it is not defined for the items that are included in the other non-cash items, then you can leave it. The other non-cash items will actually be taken away from our capital employed. 2017 figure, this 3 million will be taken away. But if they have defined what the components of other non-cash items are, then you can adjust it. But if it is not defined for you, you can move on because they have given you the provision for doubtful debt and other items already. Those are the ones that we'll be using to adjust. Okay, but if they should give you what the other non-cash items were, and they are going to be having effect on our capital employed, then we can adjust that. Okay, so since the definition is not given to us for the other non-cash items, we can ignore and now move on to our provision for doubtful debts. Okay. So the tax is the cash paid in the current year, 4.5, and an adjustment of 0.25 for deferred tax provisions. There was no deferred tax balance prior to 2018. If there should be a deferred tax balance, deferred tax is a non-cash item, which is going to be taken away from our capital employed. So we go and add it to the current year, but there was no opening balance again. This particular year's figure will be adjusted against the current year capital employed, which we are using opening. We are not using closing. So that will not have any effect over there. But let's come to the tax paid. We have that one. The provision for doubtful debts was what? 2.25 on the 2018 financial statement position. So the question now is, what is the previous provision for, what would be the provision for doubtful debts for 2017? If the current year is 2.25 and the increase for this year is 1 million, we have added 1 million to a particular figure and we are getting 2.25. So what would be the provision for the last year?
1.25.
Okay. What will be the impact of provision on last year's opening capital, on last year's closing capital rather? What is the effect of provision for doubtful debt on our capital?
It is deducted.
Okay, it will reduce, isn't it? Okay.
Yes.
That particular provision for doubtful debt, which is 1.25, okay, has been taken away from this figure. But provision for doubtful debt is a non-cash item. So it means that this particular figure for 2018, the provision of 1.25 has been taken away, which is a non-cash item. So it means that it has reduced our capital employed. So we have to come and add it back. So the provision of 1.25 should not be subtracted from the figure in the first place. So you come and adjust your provision for the 1.25, which is the difference in that particular figure. So we have done with the research and development expenditure. We have done with the provision for doubtful debts. The tax is not going to be having any effect. The depreciation is not going to be having any effect also. And research and development expenditure has been done. But the other non-cash items, okay, the other non-cash item here, it can be profit on disposal of an item, or it can be any other item. Okay. Yes, I saw Hannah. Yeah, I saw a hand up, Mohammed.
Senior,
Yeah.
please can you take the research and development, how we got the 114 times 12 again?
It's 1.2 multiplied by 4.
1.2
multiplied by 4.
4. Okay, please, why are we multiplying by 4?
Okay.
Yeah.
It is 4 years. The research and development expenditure is for 5 years. Okay, it is for 5 years. We have used 1 year, so remaining 4 years. So we are spending 6 million. We have used 1 year already. So how much will be remaining for the 4 years? So that is the 6/5 multiplied by 4, because we have used 1 year already. It's just like you finding the carrying value of a particular asset. So it will be the cost minus the accumulated amortization. So we have amortized it 1.2 million for the current year. So we have 6 million. What will be the carrying value? That will be 6 minus 1.2. 1.2 or 1.2 multiplied by 4, because every year is 1.2. You have 4 years remaining. So 1.2 multiplied by 4.
Right. Thank you very much. Please,
Okay.
I kindly slow down a bit for us.
Okay. Yeah, someone is talking about deferred tax. Please, with the deferred tax, isn't it in 2017? No. Look at what the question is saying there. Tax is the cash paid in the current year. Okay. Tax is the cash paid in the current year. So we paid 4.5 million. Okay. an adjustment of 0.5 million for deferred tax provisions. There was no prior deferred tax balance to 2018. The question is specified that there was no deferred tax for 2017. The deferred tax, which is the adjustment over there, deferred tax is adjusted against current tax if it is increasing. So we paid a tax of 4.5. The tax figure we have over here is 4.75. It means that we have added the 0.252, which is a deferred tax for the current year. The question says there was no other deferred tax for the current year. Okay, please, the non-cash item.
Hello,
Yeah.
hi, sir. Please, why did we add the research and the doubtful debt to the opening balance for capital employed?
What did we add? The research and what?
The provision for doubtful debt to the opening balance of capital employed.
Okay, the provision has reduced our capital employed because provision of 1.25 was taken away from our last year's work.
I thought we were going to record it.
Can you hear me? Please, can you hear me? The person who asked the question.
Can hear you, sir.
All right.
Can hear you, sir.
Okay. The provision for doubtful debt is going to be taken away from debtors figure, which is the debtors figure will be reducing. Okay. But we are only interested in cash items. Provision for doubtful debt is a non-cash item. This provision of 1.25 was charged in the 2017 year, which reduces our capital employed. So if you are coming to the current year, we are looking for the capital employed in cash form. So it means that the 1.2 over here has reduced the actual capital employed in the 2017. So come and add it and now have your cash capital employed at the beginning of the year. So that's why we are adding the 1.25 to now have the cash capital employed at the beginning of this year. This has been subtracted from the last year's capital employed. Okay. If you come to the research and development expenditure, the research and development expenditure is for this particular year. Okay. But this research has been undertaken at the beginning of the year. This particular research is going to be adding value to the entity. So that this particular research has also contributed to what? To the cash profit that we are having. So since it has also contributed to the cash profit that we are having, we need to also give the share of their return to them. That's what we are adding. If it should be done at the end of the year, it has no effect on the cash profit because items that are from the beginning of the year are those that will be used to generate the profit. The research and development expenditure was started at the beginning of this year. So it means that it has also contributed to our profit that we are reporting. So we need to also find their return also on that particular figure. That is why we are adding it. Okay. If it should be at the beginning of the year, we don't add. But if it should be at the middle of the year, then we prove that we find only 6 months of it because it has contributed only 6 months worth to our profit. So we are adding because it was started at the beginning of the year. If there's no operating leases too, if there's operating leases too, we also add it because we are taking assets to use. It will start from the beginning of the year. We are using this asset also to generate the revenue. So what is the return that we are getting? What is the contribution that that particular asset is also giving to us? We add it. They also contributed to the profit that we have for the year. So that is a research and development expenditure. So let's come to the non-cash items. So I'll be adding the non-cash items here. Okay. The non-cash items are also going to be having effect on our profit. The net asset is calculated as shareholders fund plus the long-term debt. Okay. If you come to other non-cash items, for 2017, this has been taken away from our profits. Since it has been taken away from our profit, it means that it reduces the profit that will go to retained earners. Okay. Yes, I saw so many hands up. Okay. Yes, please, can you put your mic off and talk?
Hello, sir.
Yes, please.
Good evening.
Yes, yeah.
Say, please, about the economic depreciation.
Yeah.
About the economic depreciation.
Yeah.
You said something about accounting depreciation and the economic depreciation.
Yeah.
And you said when we see the two, we should add back the economic and then rather subtract that.
That's not what I said.
Okay, so say please enlighten on it for me.
I say add the accounting depreciation back. That is the depreciation charged by the company. Okay, that is based on estimates. But what is a portion of the cost that is actually consumed? What is the portion of the asset that is actually consumed? That is what we are looking for. So that is what we call the economic depreciation. So it is the economic depreciation that's supposed to be subtracted from the profits, not accounting depreciation. So add accounting depreciation back, subtract your economic depreciation.
Thank you, sir.
Hello, sir.
Yes, yeah.
Yeah, but why do we have to do that when they said that in previous years the economic and accounting depreciations were the same?
We are not doing this for 2017. We are calculating no part for 2018. So that's what they are giving to you over there is irrelevant. It will be relevant if they are different. Then we adjust it against the capital employed. The 2017 was subtracted from 2017 profits, not the current year profit. We are doing the EVA for 2017. So now you okay?
Yes, please. Thank you.
Okay. Yes, please.
Yeah. So will it affect you? You bring the effect on the capital employed, right?
You bring what?
Like assuming that
Assuming what?
it was 28.5 as given there. And then the capital allowance was the 2017, the capital allowance was 30 billion. And the depreciation was thanks to the capital employed.
Please, can you come again?
So I said assuming that the 2017, the depreciation was 28.5, and then the capital allowance was 30.
What
So the
is
difference will
what is
be
the capital
1.5.
allowance? What are you calling the capital allowance? Are you talking about economic depreciation or capital?
The economic depreciation.
Yeah, I've explained that one already. I've explained what the impact on that particular one will be. Or I didn't explain that. I've demonstrated something like that. That you find the difference between them and take it from your capital employed. You're supposed to subtract the economic depreciation, not accounting depreciation. So the accounting depreciation can be higher. You go and add back the difference. You're supposed to take your economic depreciation from your net asset, not accounting depreciation. So the accounting depreciation is higher, go and add the difference back. It means that it has reduced your capital employed. If it is lower, then it means that you have overstated your capital employed. Find a difference and go and subtract.
Okay, then the next question is about the capital employed. We have two capital employed, the 385 and then 380.5. But we are taking the 318.5. I don't know the reason why we're taking that one.
They say you have 380 and what?
381.5 and then 380.5.
Okay, look at what has been added to the 380.5.
For regulated service only.
The service of the company is you only regulated service.
No, please.
Okay.
Thank you.
Hello, sir.
Yes, please.
Please, the research and development, why have we added the whole figure to the no part before we deducted the amortized amounts?
What is over here? What is over here? Operating cost, isn't it?
Yes, please.
Okay. Look at this one. Note, total operating costs include what?
Okay, operating costs. Okay, include depreciation. Okay, research and development. Both 2017-18.
So is the research development expenditure of 6 million part of the operating cost that we are subtracting before getting a profit?
Okay.
Isn't already answer my question? Was it part?
Yes, please. It was subtracted from our profits.
Okay. So we supposed not to subtract the 6 million. So what do? Go and add the 6 million and charge only amortization.
Yes, okay.
So let's
All
come.
right. Thank you.
Let me go to the non-cash item. So the non-cash item can be a profit from disposal of assets. So other non-cash items, if it is profit from disposal of assets, and they are not giving it as income. Okay, it can be a loss from disposal of assets. Since it is a figure that they are subtracting, it can be a loss from disposal of assets. It can be impairment loss. All these things are going to be reducing our net asset for the previous year. So you go and add the non-cash item of 3 million to your capital employed, because this has reduced our capital employed from the subsequent year. This one, if it's an impairment, the impairment will be taken away from our assets. If it's a loss on disposal of assets, it will be taken from the profit. So it means that this has been taken away before we get a 2017 figure. Then the 2017 figure will now be taken to what? Will now be taken to 2018. So the impact of the 3 million, which is on 2017 figure, which is a non-cash items, is still in the 2017 figure that we are using as opening balance or opening capital employed for 2018. So let's remove that particular effect. Removing that particular effect, which is a non-cash item, means that you have to go and add that particular figure back. So let's find our total capital employed and move on. Someone was asking we should check this figure again. So let's check that one and see. 17.75. Okay, so let's move on. 31.8, 318.5 plus 4.8 plus 1.25 plus 3. I'm getting 327.55.
Yes, that's correct.
Okay.
Yes, it's correct.
So can we say that our EVA now is 23.93 minus, okay, let's find our work now. So we need to find the work. Okay, so we need to find the work. The work will be the question will always give you the percentage. Okay, so our capital structure, what is the percentage of the equity?
40%.
Okay, so that will be 40 divided by the total. So the total capital structure will be 40 plus 60. So you just have 100 over here, multiplied by your cost of equity. What is the cost of equity?
16%.
Okay, so you have the 16%. So multiply this by 16%. Then you now have what percentage is the debt? 60 over 100 multiplied by your cost of debt, which is a pre-tax cost of debt. You multiply by the after-tax rate. So we have 5% multiplied by, so you have 5%. 5% multiplied by 0.75. Okay, it should always be after tax cost of debt. So we have the WACC is equal to 0.4 multiplied by 16% plus 0.6 multiplied by what? 5% multiplied by 0.75.
No.
Getting
Please
3 point.
question.
Yes,
0.0375.
Please the question. Hello.
I can hear you.
Please the question.
Yeah.
Yeah, the what? The first one, the 40 over 100 times 60 plus 60 over 100 times what?
60 over 100 times what?
5. But I don't know what is multiplied to it.
Is 0.75 after tax rate. Our tax
What did
rate,
you?
our tax rate is 25%. So the portion that we are retaining is
Okay.
25%. Yeah.
Okay.
Okay. If there was no information relating to the research and development expenditure, take the research and development expenditure and add it to your capital employed. It should not be charged to profit or loss. All right. So more
Total will
than
be 8.65.
total will be what?
8.65%. 8.65%.
Okay, 8.65%. So you will now have your 0.0865 multiplied by the capital employed to be 327. 327. 327.55. We are having 23.93 minus what?
28.33.
28.
28.33. 0.33.
Hey, 28.33. 28. So it means that they are not adding any value. So what are we getting? Negative what?
4.4.
Okay, so we are having negative 4.4. So no value has been added. The value of the shareholders has reduced by that particular figure for. Okay, so it means that the company is not adding any value. They are either reducing the value of the shareholders. Okay, so let's come to the B part.
Hello, sir.
Yes, please.
Please, the non-cash item, please, how do you get the 3? I think I lost you.
The 3 is given in the question.
Okay, for 2017.
Yes, please. Yes, please.
Please, can you explain why?
What are you saying?
I was asking why we will use that for 2017.
You are asking why we are using the 3 million for 2017.
Yes, please.
The 3 million is for which year?
2017.
Okay. So what's this is a non-cash item. What will be the effect of the non-cash item on capital employed? Assuming this is a loss from a sale of fixed assets. what will be the effect of this on a profit?
It will reduce profits if it's a loss
Okay, but the profit will be sent to where?
next year.
No, the profit will be sent to statement of financial position for that year.
Yes.
Okay, and this profit will form part of the capital employed. Capital employed is the shareholders fund plus the long-term debt. So the retained earnings is part of the shareholders fund. Okay, the cash portion of the profit is reduced by 3 million. Okay, and this is going to be reducing our capital employed for 2017. We are bringing the capital employed to 2017 now. We need cash capital employed, not what? Accounting capital employed. So the effect of the 3 million, which is the reduction of capital employed for that year, must be adjusted against the opening capital employed for this year.
All right, please. Thank you.
All right, let's look at the B part. Who is reading the B part for us?
Assess whether DPG meets its regulatory ROC target and comment on the impact of such a constraint on performance management at DPG.
All right, so assess whether the DPG meets its regulatory ROC target and comment on the impact of such a constraint on performance measurements. So let's come to what do we do? The only thing that we do is that we are looking for the regulatory division. So what is their profit? The ROC, which the ROC is calculated as the operating profits before interest and tax. Operating profit before interest and tax. Before interest and tax. Let me just write net profit before interest and tax. So net profit before interest and tax over the capital employed. Okay, multiply by 100. So let's go and pick their profit there. Let's go and pick their profit there. So what is their operating profit? Regulated.
Regulated is 115.
Are you sure?
115.
23.
Okay, that is 23. So we have the ROSI will be 23 divided by, okay. Let's look at the measured by regulator for regulated service only. Which one are we going to be picking? Which capital employed are we going to be picking for them?
2017 closing balance.
Which is how much?
380.5.
Okay. So you pick the 380.5. It is this one that will be used to what? To generate your cash for the year. So let's have this multiplied by 100. What are you having?
6%.
Is how what percent?
6.
Okay.
Sir, please, how did you get the 23?
What did we do? What?
How did you get the 23?
Or the 23 is giving the question.
Okay.
But sir, the 23 is it negative or positive? Because I'm seeing negative 23.5.
No, regulated service, regulated. Revenue for regulated is 138. Their operating cost is 115. Their operating profit is 23.
Okay. Sorry.
Okay. What is their pre-tax what? Rosie. What is their pre-tax Rosie? 6%.
6%.
What are we having for this one also?
6%.
So has the target been met?
Yes.
Yes.
Okay.
Yes.
So if the target has been met, what is the okay? What is what they are talking about over here? Assess the whether these people they have met that particular and comment on the impact of such a constraint on performance management at GPD. Okay, the target has been met, isn't it? Okay, but this is what Rosie is calculated using what accounting issues. Okay, it's calculated using accounting profits. So because we have a target, we are all human. Because we have targets, the accountant can decide to what? Can decide to manipulate what? The profit so that we'll be able to be getting what? The 6%. Okay. And such that also is not what? It's not actual return because we are using profit. Profit is not cash. Okay. So this must also be misleading because at the end of the day, if we are to be using the actual cash profit, that is being generated, the performance target must not be met. So this will be open to manipulation, and this is also not what? This is also not cash. So this might be giving us what? A wrong signal about the performance of the organization. Okay, I saw a hand up. Desmond. Okay, that might be your old hand. Okay, so let's move on to this. Okay, let's move on to B. To measure the performance of a divisional manager in responsibility accounting, it's suggested that performance of each division must be assessed using controllable profits, not a traceable profits. Explain the term responsibility accounting. Okay, what is responsibility accounting?
Responsibility accounting is the system that segregates revenue and cost into its own area of responsibility. And in order to monitor performance and assess their operations.
Okay, thank you, Zina. Anyone else?
Yeah, it's a term used to describe a situation where organization is split, organizational responsibility are split into components, and each component is assigned to a manager or a team of management.
Okay, that is not bad. That is not bad. And someone else? Responsibility accounting. Responsibility accounting. Do you have anyone
So
else?
can I try?
Yes, please.
Yeah. This is the accounting whereby the manager is responsible for both investments and costs placed under him.
Okay, you are defining investment center That is also part of the responsibility accounting. That is a type of responsibility accounting. Okay. But please, if you go to the exam, you see this thing over here. Yes, please.
Okay, I wanted to also bring my view.
Okay, senior.
Okay, I would say it's a system of accounting where managers are held responsible for areas under their control within the section or department in an organization.
Okay, that is nice. That is nice. Okay. So anyone else before we move on to okay. So you see that a company with so many components or a company with so many business units. Okay, a company with so many business units. You can see that if you have Coca-Cola right now, we are going to be having a lot of depot. Okay, and a depot will be assigned to what? Individuals. Okay, at the end of the day, the individuals must account for the resources that have been entrusted under their control. So you trying to head every individual responsible for their responsibilities. That is what we call responsibility accounting. So divisional managers, mostly is for divisional managers. Okay, we have a lot of divisions, and these divisions, managers are being assigned to them. So resources will be given to them. At the end of the day, they have to be held responsible for how the funds are being used and how they use the funds to generate revenue. So this is an accounting system where managers or directors of each business unit are being held responsible for things that are within their control. If you are looking at the performance responsibility accounting of a manager, you have to look at things that are under the control of the manager. So we use the principle of controllability there. So things that are outside the control of the manager, you cannot use those things to assess the performance. If there are sales now, the sales will be made by the head office, but they will just apportion the sales to the divisions, or the sales or the head office will now do advertisements for the products, and they will now apportion the cost to the divisions. This advertisement cost is not under the control of the divisional manager. So we cannot use the advertising cost to assess the performance of the divisional manager. So we use things that divisional manager, they have under control, and things that they are responsible for. So things that they are responsible for, they must now account for it. So the way you talk to your MPs and those people anyhow, you are using a system of responsibility accounting because you have voted for them and you ask them to go and represent you. So it's just like a principle of stewardship. They have to now come out and say, this is how the resources have been used. The resources entrusted under their care, this is how it has been used. And that's what we call the responsibility accounting. It's a situation or it's a system where managers or business units or directors of business units are being held accountable or responsible for the resources entrusted under their control. So you can go ahead to look at the types over here. We have the cost center. People are going to be managing that, and they have to be held responsible for activities that are coming from that particular side. Differentiate between controllable profit and traceable profit. Controllable profit and traceable profit.
Okay.
Yeah, see, your distance is not coming. Oh.
Hello?
Yeah, senior.
Controllable profit is a
Yeah.
profit which are directly attributable to the performance of a manager. Hello?
Yeah, senior, I can hear you, senior.
Hello, sir.
Yeah, senior. Senior, I'm with you.
Yeah, controllable profits. They are profits that
So is it me that I cannot hear you, or is your network?
Hello.
Yes, maybe.
Yeah, I was saying controllable profit is a profit which is attributable to the performance of the manager.
Okay. 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 That is not bad. That is not bad.
Sir, I want to also contribute.
Okay.
And traceable profits are
Okay, sir.
profits which include both controllable profit and other profits, which are
Okay.
attributable.
Okay.
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 Controllable profits are used to access profit centers, whilst traceable profits are used to access investment center.
Okay. Okay.
Hello, sir.
Okay. That is not bad. Yes, Nia.
Controllable profits are profits generated from activities that a manager is controlling. And then the traceable profit will be the profit remaining after deducting all the costs that are directly traceable to the divisions or the division from which the controllable profit is generated.
Okay. Okay. Okay.
Okay,
Okay.
senior, let me also
All right.
come in.
Yeah.
I'll say controllable profit is associated with a department or a section under the control of a manager, whilst traceable profit is associated with a product or a service that organization renders.
So now, can you come again?
I'm differentiating it with regards to where it comes from. So with the controllable profit, it comes from a department or a section under the control of a manager. Then the traceable is associated with a product.
Oh, okay. That is not bad. All right. So if you talk about controllable profits, okay, controllable profits is that particular profit that is related to the activities that are under the control of the divisional manager. Okay, so the profits that are generated from the operation of the division, but these profits are attributable to the things that are under the control of the divisional manager for that particular division. So we are selling our own goods, we are incurring our own costs. Okay, so if we match our own revenue from our own costs, those expenses that we have incurred, if we match it against those revenue that we generated without the interference of the what? Of the head office, that's what we call the controllable profits. So it's a profit attributable to what? To the manager of that particular division. It's profit that is being determined, taking into consideration the activities that are under the control of the divisional manager. But if you come to the traceable profit, it is a profit that is attributable to the division as a whole. It is a profit that is attributable to the division as a whole. So if we are having a profit, the question will tell you that, okay, the question can tell you that the profit after tax or the profit for the year is 2,000. The question will tell you that included in this particular figure is a depreciation of 200 Ghana cedis that relate to an asset that is controlled by what? By the head office, but just that they are giving out the asset to us to use. But the asset is not owned by the division. The asset is owned by the head office. So this particular depreciation is on asset that we are not controlling. So our controllable profit will be subtracted 200 over here and have the 1,800. This is a profit derived from the activities that are under the control of the divisional manager or the division. But if you count to, okay, we add the 200 back, not we subtract. Okay, that has already been subtracted. So we add the 200 back to have 2,200. That is what we call the controllable profits. If you are looking for the profit generated by the division itself, it will be the profit, which is 2,000. The revenue minus all the expenses that are attributable or that are relating to what? To the division. That's what we call the traceable profit. What is the profit generated by the division after taking into consideration the necessary expenses, necessary revenue that are relating to what? to the division. That's what we call the traceable profit. Controllable profit is used to measure the performance of the divisional manager. Traceable profit is used to measure the performance of the division as a whole. Okay, so that's what we call the controllable profit and also the traceable profit. Any question that we move on? Okay, please, you need to pay attention. Yes, please.
So the traceable profit, that one is for the head office, right?
I didn't say that.
No, I'm not.
No, please.
So the example that you are giving, taking into consideration of the fixed asset that the head office is giving to the divisional managers.
Who is using the asset?
Is the head office.
No, head office is not using the asset.
But what
So what the thing that I said, is it the head office that is using the assets?
No, it's not using.
No. The asset is owned by the head office, but it is used by the division.
Okay. So I'm saying that it's given by the head office. Okay, move on.
Yes, I said it's given by the head office,
Okay.
but the divisional manager is the one using it.
The division is the one using it, not the manager.
Okay, the division is what uses it.
Okay.
So when they were calculating their depreciation, they add the depreciation of that fixed asset to their operating expenses.
So they get a profit of 2,000.
Yes.
That is the traceable profit.
Yeah.
Okay. That is traceable profit. The profit that you are going to be getting after taking into consideration all the expenses that are a portion or that is relating to the division as a whole. That's what we call the traceable profit. Okay. But if you are looking for controllable profit, this asset is not owned by the divisional manager. It's not controlled by the divisional manager. Anything relating to the asset will be done by the head office. So this particular depreciation over there is not an asset that is being purchased by the divisional manager. So the depreciation should not be charged against their profit because it does not control that particular asset. So we only take into consideration things that have been controlled by that particular organization, things that are under control, things that they can take a decision for. Those are the things that we call the controllable items. So you just calculate your profit, take into consideration activities that are under the control of the divisional manager. That's what we call the controllable profits, which is used to measure the performance of the divisional manager. But if you come to the traceable profit, what is the profit generated by the division as a whole? The division will be having other expenses apportioned to them by the head office. That will be taken from the profit. What is the net profit after taking all the necessary expenses that is for a division? That's what we call the traceable profit. So it's not a profit for the head office. It is a profit for the division, but it is including items that are under the control of the divisional manager and items that are not under the control of the divisional manager. Okay.
Okay, so in all, the controllable one is for it's all about when a manager is being controlled. Let's say the profit that will be generated under the control of the divisional manager.
Exactly.
But for the controllable one is for both controllable and not controllable.
Exactly. Yeah.
Okay. All right.
Okay. So someone is saying why use the 380 of 2017? Okay. You see, the situation is if we have 20,000, okay. If you start business with 20,000, okay, you have to understand this. If you start business with 20,000, at the end of the year, you start business with 20,000. At the end of the year, you are having 25,000. Okay. So let's say you started business with 20,000. At the end of the year, you are having 25,000. It means that you have made a profit of how much?
5,000.
Okay. What figure was used to generate this profit of 5,000? Is it the 25,000 or the 20,000?
The later.
20,000.
So the capital at the start will always be the one that will be generating the income. So that is why we use the 380, which is the opening balance. 2017 balance will be an opening balance for 2018. Okay, unless they are asking you to calculate it on the closing balance. It is the opening balance, the capital that you have, the money that you have in your hand, it is the one that you are going to be using to generate whatever income that you'll be generating, not the closing figure. Are you okay? So that is for that. Okay. Let's come to the question number 2, which is about ratio analysis. Let's see whether we can finish this and move on. Please revise the EVA very well. They cannot give you this plenty adjustments. No, they cannot give it to you. They will give you those ones, like maybe they will give you the interest. Maybe they might tell you that the economic depreciation is the same as the accounting depreciation. So if you add and subtract, it's having a zero effect. They can also give you the non-cash items. You just have to go and add back to the profits. Then you add back to your capital from last year, because that will be having effect on capital from last year. I'm not sure they can give you the provision for that food there too. Most of these adjustments cannot be given to you, but we just have to do this so that any of them that you see, you can be able to find your way around it. 2. Okay, question number 2. Someone should help us with that.
Emma, your background is making noise.
Asna Benjamin, are you the one saying today that someone's background is making noise?
Yes, so
Hey, Hassan Ben. If you want to talk about people that their background normally makes noise during class, you are the first person.
yeah, Linus always in class and the class too. If I omit myself, they will start making noise in the class.
So what shows that he's
I'm reading.
what shows that he's not in class? Let's move on. Question number 2.
All right, question number 2.
Yeah.
The Deloitte Group comprises 2 companies, BCO and VCO. BCO is a trading company with 2 divisions. The design division, which designs wind turbines and supplies the designs to customers, and the license. And then the gearbox division, which manufactures gearboxes for the car industry. VCO manufactures components for gearboxes. It sells the components globally and also supplies WCO with components for its gearbox. I think that place is VCO. Sina, which one is the WCO?
Which one is the do you have WCO? Okay, I'm coming.
Divisions under B. I think they're talking about the gearbox here.
Okay, I'm coming in. So it's supposed to be I'm sure it will be the vehicle. Yeah, it's supposed to be vehicle.
The gearbox.
Yeah.
Okay.
Maybe I was trying to type the V and I made it the W, yeah.
Okay. VCO manufactures components for gearboxes.
Okay.
It sells the components globally and also supplies VCO with components for its gearbox manufacturing division. The financial results for the 2 companies for the 4 are as follows. Let me kind of scroll up small. Okay, so we have external sales to gearbox division. They will have cost of sales, administration costs, distribution costs, operating profit, and capital employed. Notes: includes cost of components purchased from VCO. Required: discuss the performance of VCO and each division of VCO, calculating and using the following three performance measures: return on capital employed, asset turnover, operating profit margin. B, VCO is currently working to full capacity. The Deloitte Group's policy is that group companies and divisions must always make internal sales first before selling outside the group. Similarly, purchases must be made from within the group wherever possible. However, the group divisions and companies are allowed to negotiate their own transfer prices without interference from head office. Please scroll up small for me. Elcina. Okay. VCO has always charged the, yes, I can see now.
Okay.
VCO has always charged the same price to gearbox division as it does to its external customers. However, after being offered a 5% lower price for similar components from an external supplier, the manager of the gearbox division feels strongly that the transfer price is too high and should be reduced. VCO currently satisfies 60% of external demand for its components. Its variable cost represents 40% of revenue. Required. Advice: using suitable calculations, the total transfer price or prices at which the components should be supplied to the gearbox division from VCO.
Okay. So
Thank you.
let's take the.
Hello, sir.
Yes, please.
Sir, please, this question is it part of the mock?
Yeah.
So this question is part of the mock exams, the mock paper.
Yes, please.
Was mine is not in the one I printed.
Then the more questions are two. Then you printed a different one.
There are two.
Yeah, we have two mocks, pre-mock and final mock.
Okay.
Okay. So let's come here. This is just about performance measure. Discuss the performance of VCO and each division of VCO, calculating and using the following three performance measures. So this one, you have to do this particular calculation in a table form. Okay. So let's do this in a table form. So just count to, so have your ratios here. Then you have the division there. So you just name the divisions there. So we have the design division and the gearbox division. So we have the design division and the gearbox division. Then we have the other company also, which will be the vehicle. Okay, so we have the vehicle. So you just have this one over here and bring those ratios, and now, so you can put a currency sign here and now move on. Okay, so let's come to the, okay, so we are looking for return on capital employed. How do we calculate return on capital employed?
Profit before interest and tax over.
So net profit
Net asset
before interest and divided by net assets multiplied by
100.
Okay, so okay, what I'll do is that let me change this column. Let me make it very small so that I can put a formula also somewhere. So let me do this one very well so that I can do. So let me have the ratios here. Then let me put the formula here. Okay, so the formula here, I'll look at the design division. Then I'll look at the gearbox division. Then I'll look at the vehicle. Okay. So we can have the formula over here. We know that ROSI is the net profit before interest and tax divided by the net assets multiplied by 100. Okay, so you can just go and have your, okay, what is our operating profit? Design division. Okay.
6,000.
So 6,000. Capital employed is what?
23,540.
Okay, so we have 23,540 multiplied by 100. Let's go to the gearbox also and calculate their, so their operating profit is what? 3875. So we have 3875 divided by, what is their capital employed?
32,320.
So we have 32,320 multiplied by 100. Okay, let's go to the last one. What is their operating profit? 710, 7010 divided by 82.
782,975.
Okay, so 975 multiplied by 100. So let's get their figures and put it there.
The first one is 25.49.
25.49. Okay, percent. The second one is
11.99.
11.99. Okay, the third one is what?
8.45.
8.45. Okay. So let's go to the next one.
Asset turnover.
turnover. How do we calculate asset turnover?
Sales over capital employed.
Okay. So asset turnover will be the revenue divided by the capital employed or the net assets. Okay. Divided by the net asset multiplied by a number of times. So we are looking for 1 CD. Whenever we use 1 CD of our net assets, what is the revenue that they are generating? Okay, in terms of Ghana city. So let's look at our net assets. We know that it is 23,540 here. We know it is 32,320 here. We know this is 82,975 here. So we look at the revenue for them. What is the revenue for them?
14,300.
Okay, so we have 14,300 for these people. The second people is what?
25,535.
Okay, 25,535. Okay. The last one is what?
80.
No, please.
No, it's 15,560.
Okay, 15,560.
15,560.
So you take their total revenue, 15,560.
Okay.
Okay. So what are we getting for the first one?
0.61.
0.61. Okay. So you have 0.61 times. Okay, second one is what?
The last one is 0.1.
It's 0.79.
0.79. The last one is what?
And the last one, 0.19.
0.19.
Yeah, 0.19.
Okay. Okay, the last one is what?
Operating profit margin.
Okay, the operating profit margin. Operating profit margin is calculated as what?
Operating profit. Somebody is making noise. Operating profit before interest and tax all over revenue by 100%.
Okay, so operating profit over revenue.
Revenue
multiplied by 100. Okay, so we know the operating profits already. That would be 6,000 divided by revenue of 14,300. Are we correct?
14,300.
So
Yes. 41%, 96.
Over 25.
535.
Okay, so we have 710 divided by
710 over 15,
Okay.
560.
So what are we getting for them?
So 41.96,
41.96,
15.18,
15.18,
45.05.
45.05.
05.
Okay. So what are they asking us now? They're asking us to assess the performance of discuss the performance of vehicle and each division of vehicle, calculating and using the following 3 performance measures. Okay. Please, they are not asking you to do comparison. Okay. They are just asking you to talk about this one. Okay. They are just asking you to talk about the ratios that you have calculated for them. Okay. So the design division, okay, they are talking about vehicle first. Okay, using the ROSI, what is the percentage? What is the return that vehicle is generating on the capital of the owners?
8.45.
Okay, so what does it mean? So you just talk about the meaning of this particular one. So you just take the ratios one by one. ROSI, okay, for the year just ended, vehicle was able to generate what? 8.4% on capital employed. This means that for every 1 cedi that they are using from the capital employed, they are generating what? 8.45%.
8 cedi, 45 pesos.
Okay. No, it's not 8 cedis. It's not 8 cedis.
5 pesos.
It's 80. Yeah. 84.
8.45 pesos.
Yeah. So that is 8.45 pesos. It's not 8 cedi. No. Okay. So this is 8.45 pesos. Okay. That is the revenue that they are generating. That is the return that they are generating.
Oh, okay.
Okay. That is the return that they are generating. So you just talk about you just talk about it. What is their performance? They're just talking about they are not asking to do comparison. No. Just discuss the performance of them. So in terms of ROSI, these people, they are generating 8.5% on a capital employed. This means that for every 1 cedi of the capital employed that they are using, they are only giving a return of 8.45 pesos on that, which seems to be what? To be very low as compared to the other divisions. Very simple. You move on. If you like, you can talk about the causes of this particular performance. Maybe what do you think is likely to be this one? You can see maybe the higher operating cost, the entity is not able to generate or is not able to control their operating cost. You don't have data to check. Sometimes they will give you 2 years. So you look at the increase in the revenue and also the increase in the operating cost. So at what margin, at what rate is the revenue increasing? It's the same rate as how the cost is increasing. The cost is increasing a higher rate more than the revenue rate, then we can say that the reason is the cost, but we don't have information to actually assess those things. So we just talk about their performance, 8.4 generated on capital employed, which means that this and that is it. Come to the design division and the gearbox division. Okay, design division on the other hand is generating what?
11.99 pesos for everyone.
Okay, so 25.49.
Design? Okay.
No, the design division, not the gearbox division.
And the design is 25.
Okay.
4.49
pesos.
Okay, what does it mean?
It means for every capital employed, every 1 capital employed that they use, it can be generated 25.49%.
Okay. So for every 1 cedi of the available investment that they are using, they are generating 25 pesos point 49 to the what? To the shareholders or the what? The investors. Okay, let's come to the gearbox division.
%11.99.
Okay, so you talk about that one too. But since all these divisions belong to a group, so you can talk that, okay, at the group level, design division is doing better than what? Gearbox and vehicle. Okay, so that in terms of ROSI, design division is the first performing what division in terms of ROSI, followed by gearbox, and vehicle is the next one. Okay, if you come to the asset turnover measures what? How efficient we are utilizing our assets.
Resources.
Okay. Okay. So if you count to vehicle, for every 1 city that we are using, for every 1 city of the asset that we are using, how much are we generating? 0.19 Ghana cedi, which is 19. Okay, it's very bad. 19 pesos. Okay, that is very bad. It means that our asset is used 0.19 times to generate that particular revenue that was generated. It means that we are underusing our asset, or most of our assets are old. It might be that we are having ops or old assets, inefficient or ineffective assets. We have a lot of assets that are old, or maybe we are not utilizing our asset to the maximum capacity. You are using 1 city of the cost. The return that you are getting is 19 pesos. It doesn't make sense. But if you come to the design division, for every 1 city that they are using, they are generating what?
61 pesos.
Okay, so it also means that they are using their assets 0.61 times to generate the reported revenue. Okay, so for every 1 city of the cost of the asset, they are getting a return of 61 pesos. That is also bad because it means that we cannot even recover the cost of the asset before any other thing. But if you come to the gearbox division, what is happening there?
Gearbox is 79 pesos.
Okay, so at the group level, which division is doing better than which division is doing better, followed by which division, and followed by which one?
Gearbox followed by design, then vehicle.
Okay. So let's come to the operating profit. So analyze the performance using the operating profit. Someone should take one, another person should also take one, and one person should also take one, so that we can move on to another issue. Which one?
Okay, so under the design division.
Yeah.
Over there we have 41.96%. So it means that for every 1 cedi that is generated, we spend 0.41. We spend 41 pesos out of every 1 cedi that is generated.
Are you spending or returning?
So for every 1 cedi.
Okay, it's operating profit. For every 1 cedi that is invested, it generates 41 pesos income or return to shareholders.
Hello, sir. It means for every 1 cedi sales made,
4.96% is return to shareholders.
Maybe, yeah.
It means for every 1 cedi sales made, it yields 41.96 pesos of operating profit.
Okay.
Every 1 cedi sales made.
Okay, that is also not bad. Okay. Yeah, Senior Julius, you were talking.
Oh, it's just the same as you said. For every 1 cedi of sales made, 4.96% is served as a profit.
Okay. Okay. So I saw Senior Mohammed, I saw your hand up. Or is the same thing I wanted to say?
Yes, I kind of. I wanted to say that for every 1 cedi of revenue made, 0.4196 Ghana cedis is a return on that revenue.
Okay. 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 So that's
question.
Yes, please.
So for operating profit margin, I know it to be the portion of revenue that has been used to cover operating expenses. So as to the explanation they are giving to the returns that they are giving to money, the shareholders, owners of the company, I don't really understand it in that respect.
You say you know that what?
It refers to how much of the revenue that have been used to cover those expenses. So
Which
maybe
expense? Which expense?
out of the total, the operating profit. Okay, so it's I get
It's
it's
not a profit. It's not
yeah,
expense.
No,
yeah,
so,
it's
so
not.
he will come to, like, at the end of the day, then he will just conclude that he's okay. So you can see that he's now okay. Okay. So let's move on. Yeah, Sina, I hope you're okay now. Sina Suli.
Yeah.
Yeah. So the what you are saying is what I want to say. Okay. It means that for every 1 cedi sale that we are making, we use 58 point something to cover our operating cost. Okay. For every 1 cedi sale, okay, 50 something, just find the difference between this one. The revenue is 100%. So if you are retaining 41.96, it means that the remaining portion is for what? Is for cost. It's for both direct and indirect cost. So for every 1 cedi sale that we are making, we are using 57 point something percent to cover.
58.04.
Okay, 58.04 is used to cover operating expenses, which is the same as the direct cost and the operating what? Or for every 1 cedi sale that we are making, we are retaining 0.41 Ghana cedis or 42 pesos, from which tax and also maybe interest expense will be what will be paid out of. So anyhow you put it, they are all the same thing. All right. If you count to GR boss, what is happening there? GR boss, how are they doing?
Dear boss, it means that they're not doing well at all. It means that for everyone city, revenue generated, they spend over 80 something pesos covering costs.
Okay. Okay. That is, it means that they are not efficient in managing their costs. They don't manage their costs at all. Because why can
We
you
are going to
sell?
shut them down.
Okay.
We shut them down.
They're even the organization that is making a lot of sales. Okay, that might be what you see that they are getting their items from vehicle. So maybe V might be charging them a higher cost for that particular item that they are receiving, because you see that part of their cost of sales is going to be from the component that they are purchasing from the vehicle. So if vehicle is selling as expensive or at a higher price, that is going to be affecting their cost of sales also. So this might due to the higher item or higher component that they are buying, higher price of the component that they are buying from the vehicle. You can see that vehicle is doing better, isn't it? So this better must also due to as a result of the higher prices that they are charging for their items internally. Okay, that must also be a reason. So, but in all, they are not doing well. They are not doing well at all. But let's come to the vehicle. You can see that in terms of operating profit, they are the highest performing division, isn't it? In terms of operating profit, they are the highest performing division. But the question is, how can you be retaining a higher amount of profit and your ROSI will be lower? You can see that they are having a lot of investment there, which they are not utilizing it very well. look at their capital employed, 82,975. Okay, they have the capital, they have the net asset over there, but they are not utilizing their asset very well to generate more revenue. They are underutilizing their assets. That's why their return on capital employed is very low. So it means that they are underutilizing their assets. So this one is just like a normal ratio. Do your calculation. If it is given to you yearly basis, compare the 2 years. So compare the 2 years and say which of the years they are doing better and why this year is better than the other one or this one is better than the other one. You can talk about some of the causes of this particular item being high. If the operating expense or the operating profit margin is very low, it means that the company is not able to manage their cost and maybe they are not even utilizing their assets very well, or maybe they are using aggressive way of collecting their revenue. So they are reducing their collection period, which is going to be discouraging debtors not to purchase in bulk again. Those might be the factors. So if you don't have any information, you can talk about those ones and move on. Okay, let's come to this one now. Okay, vehicle is currently working to full capacity. Okay, the Delaware Group policy is that group companies and divisions must always make internal sales first before selling outside the group. So before you even sell to external customer, you have to make sure that internal demands are being met. Okay. Similarly, purchases must be made from within the group wherever possible. However, the group divisions and companies are allowed to negotiate their own transfer prices without interference from head office. From this question, they can ask you disadvantages of negotiated transfer pricing. A situation where the two managers must come together to non-negotiate the price. It is going to be time consuming. It is going to be expensive because we can go and book a hotel somewhere to talk about this one. We are going to do refreshment. We will not even end up concluding on the issue. We have to come the next day. So it is going to be time consuming. We will come. We are not going to be reaching an agreement. We will come again. We are not going to be reaching an agreement. So this will be going to be time consuming. And this can sometimes also be partial. It can be biased because those who are able to have the English, some people, they are good at convincing. At the end of the day, they are saying non-fa. They are not saying anything, but they can actually convince you to believe them. That is Dr. UN. Okay, Dr. UN, he's not making sense, but he's convincing. That is why he's able to convince Sarkodie, D Black, and those people to come and award them bottles. So some people, they are actually convincing. Okay, so if you are good at negotiation, you are going to be beating the price. And the other person, since the person cannot, they don't have the negotiation skills, they will be suffering. So it can sometimes be biased. It can sometimes be biased, or sometimes it can affect the group profit as a whole. So one will be charging a higher price, one will be charging a lower price. At the group level, the profits might be low. So from this place, they can ask you the disadvantages of using negotiated transfer price. We have a lot of transfer pricing methods that we use. Negotiated one is part. We also use the marginal. We use the two tariff. We also use the dual pricing. We have so many ones there. You can read about them. So vehicle has always charged the same price to the GL boss as it does to external customers. It means that they are selling at the same price to the external customer, which is very bad. If you are operating at a full capacity, the question is, are you using the full capacity to meet the external demand? If that is the case, then it means that if the division want to buy, they have to buy at opportunity cost. So it's just like you are producing your capacity. So let's say the capacity of the division is 20,000 units. Okay, 20,000 units. We are selling a unit at 100. Okay, our external demand. Okay, our external demand is also 20,000 units. Okay, so it means that our capacity can only produce for the external demand. So we are producing for these people. Okay, so it means that if you want to buy any component of this, you have to pay the price that the outsiders are paying, because if you don't buy, we are going to be selling to them. So if that is the case, if we don't have any spare capacity, it means that we have to sell at an opportunity cost for you, which is going to be the price that those people will be selling. If we don't sell to them, what is the amount that we are going to be losing? So you have to pay, just like you have something and someone has ordered for the thing. Your dad is saying that he want to take it. You say that someone sent for it. So if you want to take it, you have to give me the amount that the person will be giving to me. That is what we call the full capacity, and that is for the external demand. But we have to ask ourselves, is there any capacity? Is there any spare capacity after meeting the demand of the external customers? Is there any spare capacity before they are still charging that price? We have to find out to know whether there will be a spare capacity. If there's a spare capacity, it means that you only tell the people that, okay, even if I produce this one, the machine will be there. So what would happen is that, okay, you can go and purchase whatever and use the machine because I won't use it for this period. After I'm done with these people, the machine will be free. So you can go and buy other materials and come and sew whatever you want to sew. So you charge these people at a marginal cost. Okay, so let's look at and see whether there is an issue relating to that over there. Okay. However, after being offered 5% lower price for similar component from an external supplier, the managers of the gearbox feel strongly that the transfer price is too high and should be reduced. Vehicle currently satisfies 60% of the external demand for each component. Each variable cost represents 40% of revenue. Okay, we are operating at a full capacity, isn't it? Okay, we are operating at a full capacity. So that full capacity, 60% is for external people. Okay, 60% is for external people. Okay, 40%, we are supplying 40% for the internal. Okay, so the question now is, these people, they have gotten a new supplier. So the question is, if we don't supply to them, if they don't want to buy from us, can we use the full capacity to supply to our external customers now? So we assume that these people are not going to be buying from us. If they are not buying from us, then what will be the quantity that we are going to be selling? What will be the price that we are going to be selling? Or what is the revenue that we'll be generating from the external supply? So let's come to the full capacity revenue for external supply. So determine if you don't want to buy from me. If you don't want to buy from me, it means that I will use all my capacity to produce for people outside and sell to them. So if I'm using my full capacities now to produce and sell to the people outside, what will be the revenue that I'll be generating? So let's go there and look at how to calculate that. Okay. What is the external sales for vehicle? What is the external sales for vehicle?
8010.
8,010 cities.
8010.
Okay. So, and they are saying that that represents what? What percentage is that?
50%.
Okay. So if you want to sell at a full capacity, 100% will be what? So if 60% is equal to 80/10, what will be 100%? We don't know. So you find that.
2,786.
So 100% will be 80/10 divided by 0.6. Am I correct?
Yes.
Okay.
Yes.
Okay.
13350.
13350. Okay. But what is the total revenue that we are generating from the, currently we are using the full capacity to supply 60% to external sales and 40% to these people. What is the total revenue that we are generating from the what? The full capacity now? What is the current revenue that we are getting?
15560.
Okay. So we have current revenue of 15560, isn't it? Okay. Okay. So if we are having 15560 and the revenue that we'll be getting from the external suppliers is 13350, what will happen? What will be the remaining revenue that we are going to be generating internally? If we want to satisfy only the external people.
2,210.
Okay. So revenue into spare capacity. So let's come to spare capacity. If we want to focus on only the external people, the total revenue will be 13 13,350. But now, the total revenue that we are currently getting using the full capacity is this one. So you just find the difference. That will be 2210. This 2210, where are we going to be generating it from?
Internally.
We are going to be generating internally, isn't it?
Can you give me the 2210?
Okay. If we want to focus on the external people alone, okay, we are going to be selling 13,350 to them. Okay. But our current revenue now from the full capacity is 15,560. So if we want to sell to the external people alone, we are going to be getting 13,350. But our current revenue that we are generating is 15,560. So if 13,560 is for external people, how much of this particular revenue will be generated from the internal people? That's what we are talking about. Okay.
All right, I see.
Okay. So this is a spare capacity. So it means that we have a spare capacity to produce what? To produce or to sell, to produce and sell to them at 2210. Okay. After meeting, our total revenue is 15,560. But after we have sold to all the what? External people now, we are still going to be getting 2210 from these people. It means that after meeting the 100% of the external demand, our machines will be idle, which we can use to produce and sell to these people. And this is going to be the revenue for the spare capacity. Okay. If we have spare capacity, what's supposed to be the transfer price? If we have a spare capacity, what's supposed to be the transfer price under the spare capacity?
The marginal price.
Okay. It will always be the marginal cost. Okay. So our revenue is 2210. What are they saying about the cost? They are saying that the cost is 40% of the revenue, isn't it? The question says that cost is what? Each variable cost represent what? 40% of what? Of revenue. So our marginal cost for this will be 0.4 multiplied by the revenue of the revenue. So 0.4 multiplied by the revenue figure of 2210. How much are you getting as the marginal cost?
$884.
Okay. So we are having 884. Okay. But the transfer, what is the policy? What is the transfer policy? They say that all internal sales must be met before what?
Before the external ones.
Okay. So if we want to sell to the external people, it is 1350. But currently the demand that we are meeting is 810. Okay. So if we are selling only 810 to them, what will be the portion that we will not be selling to them? The total revenue for them is 13,350. That is the external one. But if we don't want to sell fully to the external people, we want to give you portion of it now. What is the revenue portion of the amount that we are not going to be getting from the external people? Okay, so let me just say we have
460.
Okay, let me just say we have the opportunity cost here. So if we are selling fully externally, our amount will be 1350. Okay, that will be fully externally. But they are saying that we have to meet the demand of internal people before we sell to those people. It means that we are going to be cutting down the external demand to the usual amount, which is 810. Okay, 8010. So how much are we not going to be selling to those people?
5340.
5340. Okay. So if you want to sell now, what price are you going to be selling the component that you are not selling to external people? What will be the price that you'll be selling at for them? The external people. That they will be paying the same price that the external people will be paying, isn't it? They will be paying, okay. So they will be paying the same price. So our transfer price will now be the portion that we are going to be supplying based on the spare capacity to be marginal cost, plus the sacrifice that we are going to be making from the external demand. How much are you getting?
6224.
62.
Oh.
Okay. But what is the amount that we are currently charging them? What is the amount that they are currently charging them?
Seven five five.
Okay. 7550. That is the current price. So they say that, so let's look at the supplier's price. They say that the suppliers has given them 5% reduction. So the current price will now be 0.95 multiplied by 7550. What are you getting as the price that the supplier will be giving to them? Okay, so they say that, however, after being offered 5% lower price for similar component from an external supplier. So currently we are charging them 7550, but the supplier is giving them 5% reduction. So they will pay only 95% of that. So what will be that particular amount that they will be paying to the supplier?
71725.
Okay, so they will be paying 7172.5. Okay, so what will happen is that all things being equal, the price that we can charge you is 62.24, but the price that the supplier will be charging you is 7172.5. So any price within this particular range, we are going to be accepting it, but we can't charge you more than the price that the supplier will be charging you. But we can charge you between the price that we're supposed to charge you. We're supposed to charge you, all things being equal, we're supposed to charge you the marginal cost of the spare capacity plus the portion of the revenue that we are going to be losing if we don't sell to the external people. So that will be 6,224. But since you are willing to purchase the item from external supplier at 7,172.5, then any price within this particular range, we are ready to accept it. Any price within 6,224 and 72.5, we are ready to accept it. So that will be the transfer price will be set between these two amounts, but it will not be higher than the amount that it will not be higher than the amount that the external supplier will be charging them. So this is how basically the transfer price for this one should be determined for them. All right. Okay, let's come to the B side, which is also about performance.
But
Hello, sir.
Hello, sir.
Yes, ma'am.
So please, does it mean that? Please, can you go to the calculation? Let me ask this. The calculation, yeah.
Yeah.
Please, does it mean that the opportunity cost, the 5,340, that one, if they sell it to, does it mean if the company sell it to the internal one, they are going to make a loss of 5,340?
No, if they don't sell to the external people, they will be losing a revenue of 5,340. Okay, but if they sell to the external people, they will make a revenue of 5,340. But since you want to buy it, it means that either you pay that particular amount for it, or we go and give it to the external people who are willing to buy. So if you don't pay the amount that the people are willing to buy, then we are going to be giving it to them. Because if we don't sell to them, we are going to be losing this amount that we will be getting. And the people are willing to buy at this price. So either you pay for it or I will sell it to somebody.
Oh, okay. So the transfer price there, as I said, the 6,224 mean that if the company sells to the outsiders, they are going to generate an amount of 6,224.
No.
That is
no. If we want to, the only thing is that if we want to supply things to you right now, okay, our customers are ready to take whatever we are producing. Okay, you can see that if we want to meet the external demand, we are only meeting 60%. If we want to meet 100%, we are going to be generating a revenue of 13,350. If we want to produce for only the external people, okay, we are going to be generating a revenue of 13,350. Okay, but our current revenue over here, our current revenue right now is 15,560, which is for both external and internal. Okay.
Okay, sir. Okay.
If 13,350 is being generated from external people, it means that the remaining revenue can be generated from what? From the internal people.
Okay.
Okay. Which is after we have produced and sell it to the external people, the machines will be there, or our production process will just be there. We'll not be doing anything. So we can produce and sell to you. So we have a spare capacity. If you have spare capacity, the goods should be transferred at a marginal cost. That is why we find 0.4 times 2210. So if you are interested in getting the surplus after meeting the demand of the external customers, if you are ready to get the quantity that we give to you, we give it to you as the cost that we incur to produce it, which will be the 884. Okay. But since you want us to meet all the demand for you, if you want us to meet all the demand for you, it means that we have to cut down demand for the external people.
Okay, sir.
Okay. So if you want to cut down the demand for the external people, it means that we are not going to be getting that amount from the external people. So it's either you pay that amount to us or we go and sell to people outside. So that's why we have the 5340 as the opportunity cost there.
Okay, sir.
All right. All right.
So the 6224 now, that one becomes the transfer price.
Yes.
That is when if the internal is willing to pay.
Yeah, if they are willing to pay for all their demand, then they have to pay 62240 for us. 622.
Oh, okay.
Okay.
244. All right, sir.
All
right. Okay. Then the suppliers one.
Yeah, the supplier is willing to give them 7172. So it's either you purchase from us at 6224 or an amount higher than 6224, or you go and pay out, you go and purchase outside, which is 7172.5. So if you go and buy the item from outside, this is the amount that they will charge you. But if you want to buy from us, we are going to be charging you amount between the two amounts there.
Oh, okay, sir.
Right.
Okay, sir. Thank you.
All right, sir.
All right.
Yes, sir.
Yeah. And please, I wanted to find out if it's advisable to just do 40% on the full capacity as opportunity cost.
Yeah, you want to do
40% on the full capacity as opportunity cost.
Okay. What are you getting?
Yeah, I'll get a 5340, but I'm only asking if it's advisable to do that.
Oh, that might be. So you are doing 40% on that particular amount as the what? As the
opportunity cost for.
Okay. Why are you? The reason why you are doing that is that, okay, we have 60% to be 810, isn't it?
Yes.
So it is not 100%. That is what 13. So we added 40%. That is why we are getting it. So maybe that might actually be a coincidence, or maybe the question can be in a different way. So it depends.
Okay.
All right.
Okay.
All right. Thank you. So let's come now to the B part, which is also about performance measurements. Okay. Yeah, Sineben, help us with that.
Okay.
Please, this question, this will be for 20 marks at least. They will ask you theory and calculation questions at least. Whatever be the case, make an attempt. Nobody's going to return the script to you. Nobody's going to give you the script to read what you have written. No, write anything there and move on.
Hello, sir.
Yes, please.
Yeah, please. So if in case there's no spec capacity, then it will be sell to the internal one as what?
The full selling price. if there's no spare capacity, it means that whatever we are going to be selling to, we are going to be cutting down the demand for the external people. So we sell at the full price for you. So if we don't have any spare capacity, I'm supplying 20,000 to a customer. If you want to purchase it, it means I have to cut down the customer's demand. So it's either you pay the amount that the customer is paying to me, or I'll go and sell it to the customer.
Oh, okay, sir. So the transfer price is the same thing as the external ones are also buying.
Yeah. So we also charge the best that we can do for you is to reduce it by 5%. That is the best that we can do for you.
Okay.
Okay. All right. Okay. Yes, Naben.
Okay, I'm reading.
Yeah.
D. JAM has a network of sports clubs, which is managed by local managers reporting to the main board. The local managers have a lot of autonomy and are able to vary employment contracts with staff and offer discounts for membership fees and personal training sessions. They also control their own maintenance budget, but do not have control over large amounts of capital expenditure. A local manager's performance and bonus is assessed relative to 3 targets. For every one of these 3 targets that is reached in an individual quarter, $400 is added to the manager's bonus, which is paid at the end of the year. The maximum bonus per the year is therefore based on 12 targets. That's 3 targets in each of the 4 quarters of the year. Accordingly, the maximum bonus that could be earned is 12 by 400. I think the currency has varied, dollars to Ghana cedis now.
Sorry.
Which represent 40% of the basic salary of the local manager. JAM has, as at 31st March, and JAM has a 31 March year end. The performance data for one of the sports clubs for the last 4 quarters is as follows. We have quarter 1 to 3. Then the item, number of members, member visits, personal training sessions booked, staff days, staff lateness days, days in quarter. Agreed targets are 1. Staff must be on time over 95% of the time. No penalty is made when staff are absent from work. 2. On average, 60% of members must use the club's facilities regularly by visiting at least 12 times per quarter. On average, 10% of members must book a personal training session each quarter. Required. Calculate the amount of bonus that the managers will expect to be paid for the latest financial year. B. Discuss to what extent the target sets are controllable by the local manager. You are required to make a case for both sides of the argument.
Okay. So this
Thank you.
This is also a performance measurement, which is going to be based on a reward scheme. You see, whenever you have a reward scheme, it is likely that management will be manipulating the system to get a reward, because we are all humans, okay? And people will say that who see no chop. Yes. So if targets are being set, it is likely that management is going to be manipulating the system. So these people, what we can do over here is that some people, they can stick, if they realize that no, for this particular quarter, the target will not be achieved, they can just defer some of the book sessions to the second quarter, so that they can actually get the bonus, or they can send some of the bookings that was done for maybe in the future, they can send it to the present term, so that they can actually, so they have a way of manipulating this issue. So whenever you have a target which maybe a bonus payment or bonus is based on, it is likely that people are going to be manipulating those issues. So they can ask you about maybe that particular issue. But let's come here. Okay, what are the targets? Okay, staff must be on time over 95 days of the time. No penalty is made when staff are absent from work. Okay, what are staff days? What are what is the total?
450, 450, 450, 480, 470, and 480.
Okay, so if staff are late for 20 days, what will be the actual number of time that they are going to be at work?
That would be 430.
Okay. The second one will be what?
Second one will be 452.
Okay, the third one will be?
The third one will be 432.
Okay.
42.
Okay, and the
Then the
fourth
other
one?
one will be 460.
Okay, so let's go and do the calculation in a table form. Okay, so let's do a calculation in a table form. So let's have our targets. So let's have the quarters. We have the first quarter. So we have quarter 1, quarter 2, 1, 2, quarter 3, and quarter 4. Okay, so let's have the targets here and do the calculation for them one by one. Okay, so let's have the first target. The first target is that 95% of the staff might be on time, isn't it?
Over.
Okay.
I think it's over 95.
Okay, over 95.
Oh, it's over 95.
So we
Yes.
have to look for the over 95. Okay. So they might be the number, the staff over time might be 95% on time. Over 95% on time. So let's now look at this. Okay. The staff days, what is the total number of days allocated to them for the first quarter?
450.
Okay, but they have been late.
480.
They have been late for how many days?
20, 28, 28.
Okay, so for the quarter 1, they have been on time for what? For how many days for quarter 1?
430.
Okay, so they have been on time for 430. So you want to find the percentage of being on time, will be the 430, that is being on time, divided by the number of total days available.
450.
Okay, so you just ask yourself, they say that they should be over 95% on time. So we are giving a staff days of 450. We have been late for 20 days. It means that we have been on time for 430 days. So what percentage out of the total time is what is the percentage here?
95.56.
95.56. Okay, the target has been achieved over here, isn't it?
How did we get the 430?
Yes.
Okay, the 430 is the days that has been allocated to them. So in quarter 1, the total number of days for them is 450. Okay, they are saying that you have to be on time over 95. Okay, but they have been late for 20 days. So if the total number of days allowed is 450 and you have been late for 20 days, it means that you have been on time for 430 days, which is 450 minus 20.
Okay, sir. All right.
The second quarter is what? The number of days that
It's 480 minus 28.
Okay, so that will give
It's
us
28.
452. Okay, we have
452 over
452
480.
divided by 480 multiplied by 100. What are we getting?
94.17.
94.17. The target has not been achieved here, isn't it? Okay.
Yes.
So let's go to the
next one.
The next one is what? 470 minus 28.
28.
Okay. So what are we getting? What are we getting? Would that be 442?
442. 442.
Divided by 470 multiplied by 100. What are we getting?
94.04.
Target has not been achieved, isn't it?
Yes.
Okay, the last year, let's look at the last year. What are we looking at that? So that will be 460.
460 minus 20, so
Okay.
that's 440.
Multiplied by 100. What are we getting?
You get 95.65.
Okay, 95.65. So you can see that
95.83.
Okay, no problem. Since it's over
95.
since it's over 95, it means that the target has been achieved. Okay, so we have achieved only two targets over here. Target for only two quarters, quarter one and quarter two. Okay, let's go to the next target being set for them. Okay, on average, 60% of members must use the club facility regularly by visiting at least 12 times per quarter.
12 times.
Okay, so we have at least 60. So the second quarter, the second target is at least 60% of the members visiting. Okay, and each member must visit
That's
what? How many
12%.
times? Each member
12
must visit how many times? 12 times per quarter.
At least 12 times.
Per quarter. So let's come here. How many members do we have?
3,000 in quarter one.
Okay, if each member is visiting 12 times, how many visits are we going to be having in quarter one?
36,000.
36,000.
Okay, but they are saying that at least 60% of that. Look at the members' visits. This is the actual visit for the quarter, but we just compare the target to whether the visit is okay. So if we want to do this, we look for whether the 0.6% of the people has been visiting. So we have multiplied by 12. So the number of visits that we
3,000 by
supposed
12.
to, okay, the number of visits that we should have for the quarter is
21,600.
Okay,
21,600.
so we have 21,600 visits, isn't it? Okay.
Yes.
But let's come here. What is the visits here?
20,000.
Okay. Do we achieve the target?
Yes.
No. The target is that at least 60% should be visited. This is the
It's
actual
at least
at least 60%. So it is starting from the 21,000 more. At least two means that at least if you have
okay.
give me
Okay.
at least 2
Okay.
cedi, means that give me 2 cedi or more. Okay.
No, well understood.
Okay. So the actual visit is 20,000, but the visit based on the target should be 21,600.
21,600.
Okay. So we are saying that 60% of the people should visit. So we have 3,000 members, and each member is visiting 12 times. So what's supposed to be the target? The target is the 60% multiplied by the number of visits, total number of visits that we have. Then we now come and compare with the actual visits. This is the members' visits. Only 20,000 people visited. Target has not been achieved there. So let's move on to the second one. Okay, we are going to be having 3,200 multiplied by 12, multiplied by 60%, isn't it? Okay, so we have 0.6 multiplied by 3,200 multiplied by 12. What are we having?
23,040.
Okay, so 23,040.
40.
Okay, this is a target. But what is the actual visit?
It's 24,000 also.
Target has been achieved, isn't it?
Yes.
Okay, so it means that they visited more. So target has been achieved for this particular one. Let's go to the other one. We have 3,300. Okay, 3,000, 0.6 multiplied by 3,300 multiplied by 12. What are we having?
23,760.
Okay, so let's be writing the actual visit here. Okay, let's have the actual visit here. So this was 20,000 visits. Okay, target has not been achieved. This was 24,000.
24,000.
Target has been achieved.
So
what
the
are
other one is 26,000.
Okay, this will be 26,000. But the target set for them is what? What will be the target?
The other one is 24,000.
Okay, but what is the
24 for the
target?
lab.
20,
Okay.
The actual is
quarter three, it's 23,760.
23,000.
760.
Did they achieve the target?
Yes.
Okay. Let's go to the last quarter and we'll look for that. So the last quarter will be 3,400. 3,400. So we have 0.6 multiplied by 3,400 multiplied by 12. What is the target for them?
24,480.
24,480.
480.
Did we achieve the target there?
No.
No. Okay. So if you come here, target has been achieved here. Target has not been achieved here. Target has not been achieved here. Target has been achieved here. Target has not been achieved here. Target has been achieved here. Target has been achieved here. Target has not been achieved here. So let's go to the last target and we look at the, so the other one is that on average, 10% of members must book a personal training session each quarter.
Session.
So what is the personal sessions booked for the first quarter?
310.
Okay, but they are saying that 10% of the members must book that one. 10% must book each quarter. So what is the members that we have for quarter one?
That's 3,000. So the members will be 300. 10%
Okay.
will be 300.
So 10% of the members must visit that. So that will give you 0.1 multiplied by 3,000. That will give us 300. But the actual visit is 310, isn't it?
310, yes.
So did we achieve the target?
No.
No, we have achieved.
Okay, it was exceeded by 10.
Okay.
Okay, the standard against that.
Okay.
All right.
The target, the standard is 300, 10%. But the people that visited is now more than the 10%. So it means that target has been achieved there. Let's go to the next one. I can take it over here. I'll have 0.1 multiplied by 3,200. The target is 320. But what is the actual booked? Actual session booked? 320.
Okay, so
320.
325.
Achieved?
Yes.
Okay.
Yes.
Target has been achieved there. Okay. Let me take the next one. That will be 310 and 339. So let me just use this one. This will be 0.1 multiplied by 3,300. This will be 330. But the people that visited is 310. Achieved?
310. No.
Okay. So we have 0.1 multiplied by 3,400. So 0.1 multiplied by 3,400. And this will be 340. The actual people is 339. Please don't approximate. Okay.
Okay.
This is bonus. So the company is the one who is going to be paying. So if one person, like you have one person to achieve the target, we are not going to consider it because we are going to be paying you money. Okay. So let's look at how many targets have been achieved. So 1, 2, 3, 4, 5, 6, isn't it? Okay. So their bonus will be calculated as 6 multiplied by what?
400.
400. Okay, 6 multiplied by 400. That will be 2,400. Because a target is 400. So you have achieved 600. You have achieved 6. They will pay you 4 on that particular. So according to the maximum bonus per year is therefore based on 12 targets, 3 targets in each of the 4 quarters. So accordingly, maximum bonus that could be earned is 12 multiplied by 400, which is represented 40% of the basic salary of a local manager. The company has a year end of 31 March over there. So calculate the amount of bonus that manager should expect to be paid for the latest year. So the manager has achieved only 6 targets. So they will pay him 6 targets for the 400. Okay. Discuss to what extent the target set are controlled by. Yes, yeah.
Hello, sir. Good evening.
Yeah.
In fact, I think I had a six. I had a six target, but my approach was different from what you did. So I don't know whether that would be correct. So let me use the last one, the personal testing training, personal training booked.
Okay.
So what I did was I found 10% of the 3,000.
Okay.
Then I divided by 300. So I had 10.33, which is higher than the 10%.
Okay. So you find you just find the percentage to check whether the percentage of the people booking is higher than the target percentage, isn't it?
Yes, that's what I did.
So you have 310 divided by 300 multiplied by
no, I had the 300,000.
Okay, 300 divided by 310.
Yes.
Okay.
And
so
I had 10.33.
Okay, let me come. Let me come. So you have the 310 divided by the 3,000 multiplied by 100, isn't it?
Yes.
10% is 300, isn't it?
Yes, 10% is 300.
Okay, so what would be the percentage for the 310? That is no problem. It means that you are finding it in terms of percentage. There's no problem with that. Okay. There's no problem with that.
Thank you very much.
All right, sir. All right, sir. Okay.
Hello, sir.
Yes, yeah.
Please, sorry, can you go over how the analysis for the over 95% was made, the first target?
They should be on time. Okay. They should be on time over 95%. So you look for the days that has been given to you. They have the number of days, the number of staff days available in the first quarter is 450. That is the total number of days. Okay. And these people, they have been late, not absent. They have been late for 20 days. So if you are giving 450 days in the quarter, you have been late for, and you have been late for you have been late for 20 days, it means that you have been on time for 30 days. The total number of days given to you is 450. And if you have been on time for 430, what percentage of the total time is representing the time that you have been on time? That's what we are looking for. So you find the number of days that they have been on time divided by the total number of days available, then you multiply by 100.
Okay, sir. Thank you. That's fine.
Hello, sir.
Yes.
I also use a different approach there. So, sir, is it? I think you can also use ratio and proportion, right?
There's no problem. If you are able to be getting the figures and get a target, there's no one way of presenting it. But this is what I think is the best way for you to understand.
Okay, that's
okay. So if you have so many approaches to get that, there is no problem with that. If you can also find, they are saying 95%. Okay. They are saying 95%. 95% should be, if you want to be on time, it should be over 95%. So you can decide to find 95% of the 450 and get the number of days that it should be on time. Okay. So 95% of that 0.95 multiplied by 450. They're supposed to be on time by 427.5 days. They have now been on time by 430. It means that they are going to be exceeding the 95%. There's no problem. All right. So that is it. The one that you are comfortable with, there is no problem with that. Discuss to what extent the targets are controllable by the local managers. You are required to make a case for both sides of the argument. Okay, this particular target set now. Okay, this particular target set now. Can the managers control these targets? The local managers, can they control this particular target?
Yes, so
Do you have control over the number of people that will be visiting the facility?
well, you might not have, but because they have a lot of incentives, it's likely they can influence them. But total control over them, they don't have.
Okay, so does it discuss to what extent? Okay, discuss to what extent the targets set are controlled by the local manager. You are required to make a case for both sides of the argument. So you talk about if they are controlled.
Motivation will be one.
Okay, if they can be controlled, why do you think they can be controlled? If they cannot be controlled, why do you think they cannot be controlled? Okay, so let's look at the first side. Okay, JAMP has a network of sports clubs which is managed by local managers reporting to the main board. The local managers have a lot of autonomy and are able to vary employment contract with staff and other discount for membership fees and personal training sessions. Okay, they also control their own maintenance budget, but do not have control over large amount of what? Capital expenditure. And local managers' performance and bonus is assessed relative to 3 targets. For every one of these targets, let's come here. Okay, you have to know that these people sometimes they have control over the targets. Okay, they offer discount to these people. So it means that the number of people that will be visiting, they can actually control them. Like they have control over the targets, because the question they are saying that they offer them discount. These people are being offered discount. So we can motivate people by giving them discount to come to the session. Okay, and these are managed by us. So we know the number of people that will be coming in, and we can also pursue these people to come there. Because we are giving them discount, we can even reduce the prices for them to come. So for the target, we have control over them because we are the one responsible for managing this, and we can actually motivate or influence these people to use the facility. But the question is, the using of the facility is not only based on the amount that you are giving to them. Before you use facility, what are the things that you'll be looking at apart from the price? Apart from the price, before you go to a restaurant, apart from the money that they will be taking from you, what else are you going to be looking at?
The trainers.
The service.
Okay, you can also talk about the service and all those things. But come here, come to this question. Okay, let's come here. What are they saying here? They don't have
They also
control
control
over.
their own maintenance budget,
Okay, but what?
but do not have control over large amounts of capital expenditure.
Okay, what are they using? This is a facility, isn't it?
Yes.
This is a facility that we are using. This is a facility that we are using. Do you know that the modern facility that we have over there, modern instrument that we have over there, can also motivate people to come?
Yes.
Okay, but do we have control over what facility we should purchase and those ones?
No.
No.
So if they have old facilities, okay, old facilities that are old, people are not okay with it, people will not come. Because what will motivate people also to come is the kind of facility, the kind of equipment that we have over there. But since we don't have control over capital expenditure, we cannot stand up and purchase the item. It means that this particular target, we cannot motivate people to come and achieve this target. We don't have control over them because of the capital expenditure. But if you talk about people coming, we have control of our own budget. we can motivate people to come. So the motivation by reducing the price and all those things, we can do it and attract people to come. But if we talk about the facilities, maybe we don't have a swimming pool. Most of the people want to now use a swimming pool. Most people want to now use the gym and all those things. How do we get those people? People, they are not only interested in the rice that they are coming to eat. They want to relax. They want a swimming pool. They want a gym. And we don't have control over this one. We can't just equipment for those things. So how do we now meet these targets? So one side, they have control over the target because they have control over the price that they are going to be charging. They can offer discount to the people. They also have control over their budgets. Okay, so they can motivate people by giving them a discount for the book sessions. But what if people want to come there because of the facility there? We can't make those capital expenditure ourselves because we don't have control over those volume of capital expenditure. If you want to buy equipment for a gym, it's not something that you are going to be spending 100 cedis or 200 cedis. No, it's going to be involving a lot of amount of money. So since we don't have those facilities, some members will not be coming, and the target will not be met. So those are the two sides that they are talking about that you should have the argument for. So they can control because they have control over the price. They don't have control over the number of people that will be visiting because of these facilities that will be there. People want to come there because of these modern facilities. We cannot purchase them because we don't have control over the capital expenditure. And that is going to be a problem for the divisional manager. So right now I'm thinking about if I should do the transfer pricing for you or I should do the divisional managers one. I don't know which one I should do for you, but let's see whether we can do the question number 3. Then if we have time, I will explain the question number 4 for you. It's about transfer pricing. Although I've solved it before, but we need to, that is about transfer pricing. But I'm certain that it can be EVA, or it can be performance valuation, or it can still be the divisional performance using the return on investment and also the maybe transfer price. Although transfer pricing came in November, they can still repeat the same thing again. So let's look at the question number 3. If we are able to finish, we use that to explain the question number 4. All right.
Question number 3.
Yeah.
The Lens Co. manufactures lenses for use by a wide range of commercial customers. The company has 2 divisions, the photographic division and the optometry division. Each of the divisions is run by a divisional manager who has overall responsibility for all aspects of running their division, and the divisions are currently treated as investment centers. Each manager, however, has an authorization limit of $15,000 per item for capital expenditure, and any items costing more than this must first be approved by head office. During the year, head office made a decision to sell a large amount of equipment in the division P and replace it with more technologically advanced equipment. It also decided to close one of Division O's factories in a country deemed to be politically unstable. Please can you scroll up for me? Okay. So now I can't see anymore.
Are you sure?
Okay. It also decided to close one of Division O's factories in a country deemed to be politically unstable, with the intention of opening a new factory elsewhere in the following year. Both divisions trade with overseas customers, choosing to provide these customers with 60 days credit to encourage sales. Due to differences in exchange rates between the time of invoicing the customers and receiving the payment 60 days later, exchange gains and losses often occur. The cost of capital for Lens Co is 12% per annum. The following data relates to the year ended 30th November 2006. Items, we have revenue, gain on sale of equipment.
Leave that one, let's come.
Okay. Note, depreciation on uncontrollable assets included in divisional overheads. Okay, 320 and 460. Then we have a, shall I go to requirement?
Yes, please.
Okay, there is some information. Let me read down before the requirement.
Okay.
To date, managers have always been paid a bonus based on the return on investment achieved by their division. However, the company is considering whether residual income would be a better method. Required, calculate the return on investment for each division for the year ended 30th November 2006, ensuring that the basis of the calculation makes it a suitable measure for assessing the divisional manager's performance. B, explain why you have included or excluded certain items in calculating the returns on investment in Part A, stating any assumptions you have made. C, briefly discuss whether it is appropriate to treat each of the divisions of Lens Co as investment centers. D, calculate the residual income for each division for the year ended 30th November 2006. Since I'm done.
Okay. So let's come here. So you can see that this is the place that we have to use the principle of controllability. You can see that they are asking you to measure the performance of the divisional managers, isn't it? Okay.
Yes.
So whenever they are asking you to measure the performance of divisional managers, we use the items that are under their control. Although they have examined the return on investment and those ones last sitting, they can still bring it. Although my vim is not there, but let's see, anything can still happen. So let's move on to this one. Please don't go and gamble with your life. Learn everything. That's why I'm even solving questions on everything for you. You can see that under the performance measurement or under the performance evaluation, at least we have looked at all the quantitative issues. Sometimes they can also ask you about the qualitative issues, where you have to measure customer satisfaction by the number of referrals that you have gotten and those ones. But for the quantitative one, let's come here. So each of the divisions is run by divisional manager who has overall responsibility for all aspects of their division, and divisions are currently treated as investment centers. Each manager, however, has an authorization limit of 15,000 per item for capital expenditure, and any item costing more than that, this must first be approved by head office. Okay. During the year, head office made a decision to sell a large amount of the equipment in Division B and replace it with more technologically advanced equipment. It also decided to close one of the divisions of O's factories in a country deemed to be politically unstable, with the intention of opening new factory elsewhere in the following. Both divisions trade with overseas customers, choosing to provide this customer with 60 days credit to encourage sales. Due to differences in exchange rate between the invoicing and rephasing payments, exchange gains and losses often occur. The cost of capital of this is 12%. So let's come here. Okay, Please don't come and prepare a new statement of profit or loss. Okay, you just pick a profit. You just pick the profit, and those items that are supposed not to be added, or those items that are supposed not to be added, those items that are supposed not to be subtracted, you come and adjust it. So we'll be starting with the net divisional what? Profit. So we'll be starting with the net divisional profit. This is what we call the traceable profit, because you can see that it has been it has been calculated after taking into consideration all the expenses relating to what? The division. So let's look at the adjustment for each of the divisions. Okay, so let's adjust the listing for them. Okay, let me just draw a line here so that I can have my listing here. Okay, so let's come to the divisions. How many divisions do we have? They are all into, their names are division
P and O.
Division P and O, okay. So division P and O. Okay. So what you do is you bring their net divisional profit. Bring the profit that have been net divisional profit first. Then you now adjust it. Net divisional profit. So how much are we getting for the net divisional profit for all of them? 25.20.
25.20.
Okay.
12.20.
Okay. 25.20. 12.20.
12.20.
Let's now count to the item that's supposed not to be going there. The gain on sale of equipment. Gain on sale of equipment. Read, please. They have given you all the information for you to make the what? Come here. During the year, head office made a decision to sell a large amount of equipment in division P and replace it with more technologically advanced equipment. Look at that. What is a gain? What is a gain?
400.
It's for which division?
Division P.
So can you conclude that this particular gain is resulting from the decision made by the head office to dispose the equipment?
Sina, come again.
Okay, I'm saying that the gain of the 400, can you say that the 400 gain over here is coming as a result of the decision made by the head office?
Head office decision.
Okay.
Exactly.
Can the divisional manager control this?
No.
No. Is someone talking to me?
No.
Okay. Okay. So it means that the gain should not be included in the first place, but this has been included, isn't it? We have included the gain before getting this. So you bring the gain on equipment. So that gain of 400 is supposed to be subtracted. It's supposed not to be included, but it has been included for that. Okay. Let's go to other items again. There are some items they are going to be doing this one. Let's come here. Exceptional cost for, okay, let's come to the divisional overheads. See note below. So let's go and adjust that first. See note below. Depreciation on uncontrollable assets included in divisional assets, 320 and 460. What do we do?
We added back.
We add it back.
Okay. We go and add back. Okay. So depreciation on uncontrollable. Depreciation on uncontrollable assets. So how much is it?
320 and
460.
the one.
Okay. So we have 320 and 460, right?
Yes, sir.
So I hope you are getting the pain, isn't it?
Yes, sir.
Yes.
Okay. So for this one, if this one counts, we just kill it and move on. Let's come here. Exceptional cost for factory closure. The direct labor. Yeah.
Why are we adding?
It has been included in it has been included in divisional overhead, which is a subtraction. So the 320 has been included over here, which has been subtracted from our revenue before getting the profit. So we have to come and add it back because it was subtracted before getting the profit. Yeah.
Okay.
Let's come to, so the direct material and those ones are the people that the divisional manager is paying, people that we are employing ourselves, the material that we are buying ourselves. So we count to exchange gain. Exchange gain, the question says that we have been trading with what? With what? With overseas customers, isn't it? Okay, it is not the head office that is telling us that we should trade with those people. It's the division itself that is trading with those people. So the exchange gain will be there. But the exceptional cost for factory closure, what is bringing this particular exceptional cost? Come here. Okay.
Head office.
It also decide to close one of the divisions of factory, divisions O factories in a country deemed to be what? Politically unstable. This decision is made by what? The head office, which is not controllable, which cannot be controlled by the divisional manager. So we bring the exceptional cost of closure that has been subtracted. The exceptional cost of closure. So that has been subtracted. We add a 1,800 back. Are we okay? Okay. So let's come to allocated head office cost.
To be added back.
Okay. Allocated. This is a cost. Sometimes it can be a cost, a general cost that is being incurred for all the divisions. Then the head office will apportion it. So this is not controlled by. So allocated head office cost. How much is it? 680 and 1040. So we add back 680 and 1040. Is there any other cost, any other adjustment that will come here?
Okay, senior.
Yeah.
In the footnote, where we're directed to.
Now this is,
I don't know whether
depreciation on
that's the only
uncontrollable
thing.
assets. Yeah.
Oh, okay.
Okay.
Okay. This one.
Okay. So let's now total the profit. Let's now find our controllable profit and now move on. So let's have our controllable.
So it means what we are doing is a full control by the head office, right?
By the manager, the divisional manager, not the head office.
Oh, okay, full control by the okay, sir.
Okay. So we call this
so division P is 3120.
3120.
Division P 3120.
Okay. Division O is what?
4520.
4420.
4520. Is it 45?
The depreciation figure, let's check it. Well, it's not 360, it's 460.
It's 460. Yeah. Okay, sorry.
Yeah, it's 460.
4520.
So 4520. Okay. So we are looking for return on investment. So let's go and find our divisional assets now. Okay. So we have to go and look for our net asset, divisional net assets. So we look at the asset that is being purchased and controlled by the divisional manager. So let's come to the two divisions. We have division P and division O. Okay. So let's come to the divisional assets, the controllable assets. Okay. So let's come to this question now. We have non-current asset controlled by the division, isn't it? Okay. So that will be part of our net assets. So non-current assets controlled by the division. So how much is it for each of them?
The first one is 15,400.
Okay, 15,100.
30 stock.
And we have the 2,700.
Yeah.
Yes, please.
But in one of the paragraphs, we're told that expenditure above a certain limit are approved by head office, or it will not influence that.
No, that is the second part of the question, whether you should classify them as investment center or okay. So these are the assets. This will not affect that. That is also having each question on each one. Non-current asset controlled by head office, would that be included?
No.
No. Okay. So we have to find our net asset now. So we have to bring the inventories. So our capital employed. What is the inventories figure for each of them?
1,800.
Okay. 1,000, 3,900, isn't it?
Yes.
We have receivables of what?
6,200.
6,200 and
8,900.
so we have 6,200 and 8,900. Please, we are looking for net assets, capital employed. So we bring our liabilities. So we have overdrafts. Okay. So the net asset is calculated as total asset minus current liabilities, not total asset minus total liabilities. No, this one we are looking for the capital employed, the long-term capital. So total asset minus what? Total current liabilities. So our overdraft is having a deduction. That will be a deduction of 500. This will be dashed. Okay. Then we count to payables. So our payables is what?
5,100 and 7,200.
So 5,100 and 7,200. What are we getting?
So we have 17,800 under P.
17,800 under P.
Then 26,300.
26,300. So we can find our ROI now for them. We can find our return on capital employed, which is the net profits before
Net profit.
it should always be after depreciation. Okay, it should always be after depreciation. So divided by the net assets multiplied by 100. So you do it for each of the division. So let's say division P. Let's go to their controllable profit, 3120 divided by 17 multiplied by 100. Okay, let's come to division O.
17.53.
So 17.53%. Okay, we have 17.53%. Let's come to division O. Let's have okay. So let's come to their controllable profit of 4,520. 4,520 divided by 26,300 multiplied by 100. What are we having?
17.19.
What?
17.19.
17.19.
Okay, 17.19. So this is how you calculate it. But if they are asking you to calculate for the performance of the division, we just use the profit reported over here. That is a traceable profit. That is a traceable profit. And we just use all the assets over here. We find a net asset using everything because these are all the things used by the division. But some of the things are provided by the head office, which is not under the control of the divisional manager. So we use the responsibility accounting to measure the performance of divisional managers. So that is the first part of it. And okay, they can also ensuring that the basis of the calculation makes it a suitable measure for assessing the divisional manager's performance. That's what we have done. Explain why you have included or excluded certain items in calculating the return on investment in part A, stating any assumptions you have made. I hope we have explained those ones already. Okay, we have answered this part of it already. Okay, so again, we say that this is as a result of the decision made by the head office. The divisional overheads, which is a depreciation, it's an asset that is not controlled by the divisional manager, so he doesn't have any say about that. So that should be added back. Then we come to the exchange gain should be included because the question says that they trade with what? External people. So the gain or the loss might be resulting from that particular issue there. But allocated exceptional cost for factory closure, this is a decision. This is a cost coming in as a decision made by the head office to close down part of the division, which is not a decision that can be controlled, or which is not a decision that is relating to the activities of the divisional manager. It's not a decision made by the divisional manager, so that should also not be included. Allocated head office costs are costs that are being pushed to the divisions by the head office. The manager has no say about this particular cost. That is also not under his control. The non-current asset control by head office, that is not also under his control. Briefly discuss whether it is appropriate to treat each of the divisions of Learn School as investment centers. Okay. So do we have to treat them as an investment center? Based on information given to us, can they be treated as investment?
No.
Oh, you cannot just say no. Okay, they are saying that, what do we call investment center? Investment center is a profit center that is charged with what? Making their own investment, purchasing their own assets. But for profit center, you only generate revenue and incur costs. You can't make investment. Okay, but let's come here. The only time that they cannot make investment is where the expenditure limit is what? Is above what? The only time they cannot make investment is where
$15,000.
$15,000.
Okay, but what if their expenditure is below 15,000? They are going to be buying the asset, isn't it?
Yes, sir.
Yes.
So you cannot just stand up and say they are no. You have to use the figure to explain. Any capital expenditure within or below 15,000, they can make it. So therefore, they will be classified as what? Investment center, because they can make their own investments. But any expenditure, any capital expenditure above 15,000, they have to seek approval from what? Management. So in case of making expenditure that will be above 15,000, there will be a profit center, because they cannot go ahead to make that investment on their own. But if the expenditure is within 15,000, they can make the investment. So their classification depends on the level of what? The expenditure. Any expenditure that is below 15,000, they are investment centers. But a situation where expenditure that will be above what? 15,000, then there cannot be an investment center. So you have to explain the two situations, because the question is saying that any expenditure limits per item for capital expenditure, and any item costing more than this amount must first be approved. So they can't make decision on their own. But what if they decide to? You see, we are all humans. Okay, we call something I've forgotten. In public procurement, there's a term for there's a term for it where the tender review committee.
Threshold.
Okay, they have a threshold that they can.
Thresholds.
Okay, so but there's a term for what they have been doing. That I've forgotten the term. There is something splitting. Is it contract splitting or something? So I can only authorize 15,000 item of goods. But if I realize that it's 30,000, I can split the item into two, so that it will be 50-15 for me, so that I can approve. So these people, they can also employ this particular thing over here and be able to make the investments. So you have to explain for the two situations. Are you okay? So you can't look at the figure and say, if the expenditure is below, if you are saying they cannot, that is if their capital expenditure is beyond $15,000. But if it is below, they can undertake that particular investment. So they can actually be classified. And it is likely possible that whenever the expenditure is above that one, they can decide to purchase a portion of it, or they can decide to pay a part of it, and they'll come and pay the remaining part, or they can decide to split the item into pieces, so that they can have their authorization limits. They can also do that. So explain for the two sides. Any expenditure below 15,000, the managers can make that expenditure without a recourse to the head office. So in that case, they will be classified as investment center. But any expenditure above the 15,000, they have to seek approval from the head office. In that case, they will be treated as what? As a profit center, or sometimes you can also use their figures over here to determine. Okay, but that will not be a problem because they are going to be having a lot of assets compiled together to have the closing balance. It is a lot of items that they added together to have this. So some of the items can be 2,000, some of the items can be 3,000, and we added all of them. You are having a total assets here. So senior, you don't have to just conclude like that. You have to use the situations given to you over there. Calculate the residual income for each division for the year ended 30th November 2006. How do we calculate residual income? How do we calculate residual income? So residual income is calculated as, so residual income is just like the EV, but just the residual income, we use profit, we use accounting profit. So you can have your net profit before interest and tax minus your imputed or your finance charge or your notional charge. Okay, so minus your imputed cost here. So we have the division, let's have division P. Their residual income will be their profit of 3120 minus, what is the cost of capital? 0.12 multiplied by 17,800. So assuming we are paying these people, we are using a net asset of 17,800 to generate this particular figure. Assuming they are demanding a return on their investments, how much are we going to be paying them? And if after paying this amount to them, what will be the profit that will be remaining? That's what we call our residual income. So what are we going to be getting?
Two one three six.
Okay, so what will be the remaining figure now?
984.
948.
984.
Okay. Oh, don't worry. They are all figures that you are mentioning, but just as you suffer. Okay. So division. So let's have division O. Division O, we have their profit of 4120 minus the what? The interest that or the return that we're supposed to pay on the capital that we are using. So 3,000. So that would be 4520 minus what?
315.
3156. Okay. So what are we having?
1364.
1368. Okay. So sometimes they can ask you which division is doing better. Okay, sometimes they can ask you that question also. But let's come to okay. Okay. So come here. Maybe sometimes okay, you don't worry about that one. I'll go and change it. Sometimes they can give you a bonus target. Look at this. They say that to date, managers have always been paid a bonus based on the return on investment achieved by their division. However, the company is considering whether residual income will be a better method. So from this one, they can also ask you the advantages of using the residual value. Okay, for that one, it takes into consideration the return, the charge that we are having, the amount of money that we have to pay on the capital. Okay, the capital that we are using to generate the income. It takes into consideration the residual income, the residual profit after we have taken care of what? The profit that we are bringing there. Okay, what I want to say is that they can give you a target that, okay, they normally pay the divisional managers a bonus when a target of this has been achieved for return on investment. So maybe they can say the return on investment is 10%. Okay, so maybe they can say 10%. You can also see they're all 15%. You can see that they are all achieving that. Okay, but if they are all achieving that, you see that the actual residual income that they are receiving is not up to that particular one. So they might be opting for this particular one better rather than the residual income. So maybe they can also ask you a question on that particular side. All right. So seniors, this is all about the performance evaluation at least. We have solved question on at least a lot of things under them. The EVA, residual income, the performance evaluation, and we also try to solve a question on transfer pricing. Although we don't solve a full question, but at least we have an idea about the transfer pricing. So we are going to be ending it over here. Tomorrow, same time, same venue, we are going to be looking at contemporary approaches to management accounting, where we look at issues of ABC and also issues of throughput accounting. Any question?
Please, sir.
Linus.
Please, sir.
Yes, please.
Can you post your solution on the platform for us?
Yeah,
because the network was disturbing some of us.
I've always been doing that, and after the class, I will just post it for you.
Okay, thank you,
so
sir.
the transfer pricing, that one too, I don't know if you can assist us with the solution. So we look through it.
No problem, no problem. I will try my best.
Thank you very much.
All right.
All right.
Hello.
Thank you, sir. God bless you.
All right.
Hello, sir.
Yes, yeah.
Please, so